Good afternoon, everyone. Good morning for those who are based in the United States. It's our pleasure to welcome you to the second day of the Adam Smith workshop. So let me introduce the first paper and the first presenter. So the first paper is Model Selection with Transaction Costs, and it's going to be presented by Mihail Velikov. Mihail, you have 25 minutes, and I'm going to warn you when you have 5 and 1 minute left.
All right. So good morning and good afternoon to everyone. Roman's warm welcome is appreciated because in the Northeast US here, at least in central Pennsylvania, it's been snowing. Didn't expect that at this time of the year, but here we are. So this paper that I'll present today is joint work with Andrew Detzel and Novy-Marx, who should be in attendance today as well. So the paper asks a very simple question, which is whether trading costs should matter when we compare empirical asset pricing factor models in the cross-section of stock returns. And the reason we're interested in this question is because we typically judge factor models based on how close they are to spanning the mean variance efficient frontier. For example, we'll look at how small alphas are in linear regressions of the returns to some test assets on the returns to the factors in a given empirical factor model. And the theoretical underpinning behind linear factor models is Ross's arbitrage pricing theory. And that tells us that the reason we expect alphas to be small is that if we had the right model and there were truly investment opportunities that had abnormal returns relative to that model, well, then arbitrage capital would swoop in, investors would buy positive alpha assets, they would short negative alpha assets until alpha is basically zero. But in the real world, that would only happen if it's profitable. With implementation costs, arbitrage won't necessarily make the alphas equal to zero. It would really make alpha minus cost equal to zero. And so what we're arguing in this paper is that the best empirical asset pricing factor model, at least in the cross-section of stock returns in our setting, is the one, or should be the one, that parsimoniously spans only the achievable mean variance efficient frontier, as opposed to the frontier that is constructed without any regard for implementation cost. The way we're going to try to address kind of our question is by relying on a recent result in this literature. So Barillas and Shanken in a recent paper essentially argued that a good summary statistic of model quality and how close a model is to spanning the mean variance efficient frontier is the maximum squared Sharpe ratio that you can achieve from the set of factors in the factor model under consideration. So they start with a fairly classic result that goes back at least to the GRS paper in the late 80s that showed us that alphas give you a sense of how much you can expand the mean variance efficient frontier in the context of how much is the improvement in square Sharpe ratio from adding a set of test assets pi to a set of factors f. And the Barillas and Shanken insight, which is a cool insight, is that if the test assets include the entire universe of assets, well, then the maximum square Sharpe ratio is the same essentially regardless of the factor model. And so what they argue is that to get the smallest mispricing, the smallest alphas, you really need to try to maximize the square Sharpe ratio of a given model. And as a byproduct, we get this nice suggestion there that to compare factor models, we really just need to compare their square Sharpe ratios, which is pretty cool because historically we've been relying on a choice of test assets, which has its own problems that I hopefully have time to get to later on. And so to motivate kind of the results in our paper and our paper as a whole, we're going to do that just for a minute here. Let's compare some square Sharpe ratios. So in a follow-up paper, Barillas and Shanken essentially compared the square Sharpe ratios between the Fama-French 5-factor model, the Hu-Shu-Jiang 4-factor model, and a 6-factor models that they themselves proposed based on a selection procedure they introduced in that paper. And not surprisingly, what they found was that the model they're proposing performs best. Its square Sharpe ratio is more than twice the Fama-French one, significantly higher than the Hu-Shu-Jiang one. So based on this criteria, they've kind of advocated for that factor model. And so what we're going to do here in this we're going to introduce a simple example, basically, that kind of takes this to an extreme. So we'll propose a single factor model that it only has one single factor. That factor will be based on a rather obscure anomaly signal called low volatility industry relative reversals. So low volatility industry relative reversals is an anomaly that Robert and I used in a recent paper on transaction costs, but I haven't seen a whole lot of papers studying or even using that anomaly. There's a few that look at industry relative reversals. Low volatility industry relative reversals is just industry relative reversals implemented in the low volatility universe. The reason Robert and I included that anomaly in our study, though, is because it has astonishing gross performance. Its square Sharpe ratio is 4.81. That's close to 4 times Fama French one, more than 1.5 the Barilla, close to 1.5 the Barilla-Shanken one. So if you buy into this argument that square Sharpe ratio is all we should care about, you might be tempted to conclude here that we found the missing holy grail of empirical asset pricing, that we've solved the zoo of anomalies and we can move on to bigger and better things. But unfortunately, we all know that's not the case. And the reason that's not the case, and a cool way to show it, we think, is that low volatility industry relative reversals is nowhere near close to spanning the achievable frontier. This bar chart here shows the square Sharpe ratios pre and post accounting for trading costs and compares the low volatility industry relative reversals square Sharpe ratios with the classic Fama French 3-factor model square Sharpe ratios. And you can see the results by yourself here. Pre-cost low volatility relative reversals has 9 times the square Sharpe ratio. After cost, its square Sharpe ratio is effectively 0. And this is why we argue that we should worry about transaction costs when we evaluate factor models. This is our paper in a nutshell, essentially. But now, before we get to the results, to the actual results, let me do a quick outline of what we're about to do. So in the paper, we basically horse race models after accounting for transaction costs, either we're comparing the maximum square Sharpe ratios or looking at a version of alphas relative to a large set of anomalies. The models we'll look at are largely based on Barilla and Shanken, the Fama French 5 and 6-factor models, the Hu-Shu-Zheng 4-factor model, and the Barilla and Shanken 6-factor model. We'll also look at a version of the Fama French models that use cash instead of operating profitability, because there's a follow-up paper by Ray Bow and co-authors that argues that cash profitability performs a lot better than operating profitability, and that's kind of what we see in our data as well. The trading costs will follow a paper Robert and I published a while ago, and would apply a simple measure of trading costs, the effective bid-ask spread from Joel Hasbrook's 2009 JF. And the way to interpret these trading costs are essentially what they would be for a small liquidity demander. Can you implement the strategies underlying these factor models using only market orders effectively? Now, there are some important limitations to what we do here, and we are completely upfront about that. We do not account for price impact, which is important for large institutional managers. There is a contemporaneous paper. I see Victor here. I don't know if any of his co-authors are also present, but they show in a cool way that the maximum square Sharpe ratio has even more problems when you think about price impact, and even for the same model, it differs by the investor you have in mind. So with price impact, it's clearly important as well, but we abstract from it in this paper. We also don't really look at shorting costs, but to the extent that one set of models that we look at is disproportionately affected by trading costs, we expect that the results will be only exacerbated essentially if we account for shorting costs as well. All right, let's look at some numbers here. So first, I want to show you some summary statistics for the factors in these models. This table, the first panel, the top panel, shows the Fama French factors, which are mostly constructed using annual rebalancing, which ends up making a huge difference, as you'll see in a second. The second panel shows the factors from the Hu-Shu-Zheng factor model, the 3 factors that are on top of the market factor, and a value factor that is used by the Barilla and Shanken model, that is rebalanced monthly based on a paper from Asnes and Frattini. So let's focus on the top panel, and in particular, just on the annually rebalanced factors first. What's notable here for them is that the turnover highlighted in this column here is very low for them. So what we mean by turnover is the fraction of the portfolio that you need to rebalance on average each month. And the way to think about it is if you had to sell the entire portfolio, buy a new set of stocks, in our definition, that would be 100% turnover. So these factors, because they only rebalance once a year, the average monthly turnover in percent here is quite low. It's between 3 and 10% per month, which results in trading costs that are basically negligible. So the costs we find for these factors vary between 3 and 10 basis points per month, but in the context of the gross returns, you can safely assume that they don't make much of a difference. The statistical significance of these factors, even after accounting for transaction costs, is still there. The only exception of the size factor, which is not even significant even before cost. That's very different for the other set of factors, though. The monthly rebalance factors have turnover that varies between 18% for the Hushu-Zhang size factor and over 50% for momentum. As a result, the trading costs are between 15 basis points for size and close to 0.5% per month for momentum. And as you would expect, this means that the net returns are a lot lower. They're nowhere nearly as impressive. They vary between 12 and 22 basis points per month, and they're only marginally significant after cost, with the Hushu-Zhang profitability and investment factors being the only one that have T statistics above 2. So already, hopefully, you see what the results would look like. The models that disproportionately use the factors that are very costly to trade tend to perform really well before cost, but their performance suffers quite a bit after cost. This bar chart here is essentially the main result of our paper. It's what we saw earlier. It's a similar chart to what we saw earlier, but it compares the square Sharpe ratios before and after cost for the 6 models that we study in our paper. You can see that before cost, we essentially find the same thing that Burles and Shanken do. Their model performs best. The blue bar for the Burles and Shanken model is by far the highest. After cost, however, the ranking completely changes. The factors that disproportionately use the monthly rebalance factors, the Hushu-Zhang and Burles-Shanken ones, are the worst performers. The sum of range factors, even with operating profitability, tend to perform better, but the best performers here are the cash-based profitability sum of range factors. The last point I want to make here is that post-cost, momentum, and we'll see that again and again in the rest of our results, momentum doesn't really add a whole lot. If you compare the red bars between the FF5 and FF6, or the FF5C and FF6C, it barely moves. That's because momentum is nowhere near as significant and doesn't have a good returns after accounting for transaction costs. So this is the main result summarized in a nice picture, but I haven't really shown you any statistics here or any formal tests. So we do a couple of things in the paper, and I'll focus on the first one in the interest of time, which we call kind of frontier expansion tests. So these are akin to a spanning test that probably most people are familiar with, where you would regress the returns to some test asset on the factors of a model. So the question we're trying to answer is whether a base model, call it M0, spans a supplementary model, let's call it M1. In other words, if an investor had access to the factors in M0, would she be better off if she were also given access to the factors in M1? And ignoring cost, that's fairly easy to test, and we've done that many times over, right? If one model spans the other, the factors will have 0 alphas. We can test those individually, jointly, and so on and so forth. After cost, however, things are complicated a bit because the factor regression intercepts are not at all the same thing as abnormal returns. Even if the intercept is significant, that doesn't guarantee that we have the replicating strategy. So what we'll do is essentially a multi-factor version of a statistic which Robert and I developed in an earlier paper called generalized alpha, that we call generalized alpha. So what we'll do here is basically test whether alpha is equal to 0 in a regression that on the left-hand side has the excess returns on the mean variance efficient portfolio constructed from the union of the factors in the two-factor model. And on the right-hand side, we'll have the mean variance efficient portfolio from the factors of the base model alone. Now that alpha is still not going to be interpretable the same way as in a spanning test, but in our RFS paper, we showed that if M1 is a single asset and you rescale the alpha using the weight of that asset in the mean variance efficient portfolio of the asset and the factors, then it fully agrees with our common notion of alpha that we know and love. So the focus here, we really want to focus on the T statistics, on the significance of the alphas as opposed to the alphas themselves. The last point I want to make is that these regressions we would only estimate if any of M1's factors actually have non-zero weight in the mean variance efficient portfolio of the union of the factors. Otherwise, we'll just report a 0 alpha and a 0 test statistic. So here are the results, and this table is somewhat involved, so please bear with me for a second here. So let me zoom in on a couple of numbers so that it's easier to understand what we're showing here. Each row represents the base model, M0 here, and each column represents a supplementary model, M1. The left-hand side panel shows the gross results, the right-hand side panel will show the net results. And looking at these couple of numbers here, essentially what this is telling us is that when we add the factors of the FF6 to the factors of the FF5, the mean variance efficient portfolio of the union, which is really just adding the momentum factor because they're nested models, has a significant intercept in a regression of the returns relative to the mean variance efficient portfolio of the base model. The way to interpret this essentially is that momentum improves the frontier relative to the FF5 model pre-cost. The flip side, these zeros here are there because when we include FF5, all of the factors are already in FF6, so we don't really estimate any regression. The union is the same as the base model. And so the overall result on the gross side, on the left-hand side panel, is that most models tend to expand the frontier pre-cost relative to other models. We know that a lot of factor models fail the GRS test. This is kind of similar, that pairwise, when you compare models pairwise, they tend to improve the frontier relative to each other. Where they don't is where they're nested models, or interestingly, when you add the Fama-French factors to the Hu-Shu-Jiang model. This is something that Lu Jiang and co-authors have been arguing, in a series of papers, that their factors tend to span the Fama-French factors. And we kind of see a little bit of that in this test using our data as well. What's interesting in our context, however, is what happens when you account for trading costs. So the picture completely flips as it did in the bar chart earlier. After costs, the cash-based operating profitability Fama-French models completely dominate. So what these zeros and insignificant test statistics here tell us is that when we add any of the factors to these factor models here on the top, the Fama-French 5 and 6 factor models with profitability, net of costs, do not improve, or the mean variance efficient frontier is not improved at all. On the other hand, when we add the Fama-French 5 and 6 factors, it's really the cash-based profitability factor that does all the work here. So any of these other factors, we have a significant expansion of the frontier. Interestingly, the relation we saw between the Hu-Shu-Jiang and the classic Fama-French factors with operating profitability changes again when we look at net returns. The Fama-French factors expand the frontier relative to the Hu-Shu-Jiang and Beulah-Shankin factors. The opposite is only marginally true for the Fama-French 5 factor model. When you control for the Fama-French 6 factor model, the Hu-Shu-Jiang and Beulah-Shankin factors do not significantly improve the frontier. The last point I want to make on this chart is that net of cost, momentum doesn't seem to add a whole lot, again, just like in the bar chart. So when you look at adding momentum net of cost to FF5, we have an insignificant test statistic. Same here with the cash-based profitability model. So in the paper, we also follow a bootstrap procedure, kind of similar to what Famo French do in their 2018 paper, to evaluate all of these claims out of sample. In the interest of time, I'm gonna skip over this, but the result, essentially, the out of sample net results are very similar to the net frontier expansion results. What I want to use the rest of my 5 minutes, thank you, Irina, is to talk about the section in our paper where we actually try to price anomalies. So this is what we've historically been using factor models, right? Famo and French, what I've heard, I wasn't around doing research at the time, but from my understanding, what sold the Famo French factor model was that it priced long run reversals, which was the premier behavioral anomaly at the time. So because of that, we wanted to have a section where we actually evaluate how well these models do after cost in pricing anomalies. Now, there are issues with that, and in particular, with how you select the test assets. We know, there's plenty of paper that show issues with the selection, and even if you have a comprehensive set like what we're trying to do here, you would still run into the problem and the selection that most of these anomalies were discovered by testing against the Famo French 3 and Carhart 4-factor models. So there's a natural bias inherent even in that. But with that caveat, we essentially use a fairly comprehensive set of 120 anomalies that were replicated by Andrew Chen and Tom Zimmerman in their review of asset pricing studies paper published last year. So these 120 actually come from a paper I have with Andrew Chen, but we took them from the RAPS paper and shortened the set out of 156 to 120 because we excluded kind of indicator variables and stuff that don't reliably produce decile sorts. And here I want to take, I know I don't have a whole lot of time, but I want to give a quick shout out to Andrew and Tom, and especially if there's PhD students. They have a follow-up paper in the Critical Finance Review called Open Source Asset Pricing, and they're posting all of their codes and all of the data for replicating over 200 anomalies. So I'd encourage everyone to check it out. They're doing a great thing, great service to the profession. So with those anomalies in hand, we want to compare the net of cost performance of factor models. But as we already discussed, we can't really estimate alphas the way we normally do. So what we're going to compare here is the statistic, which is again a form of frontier expansion measure. It's essentially the percent change in the square Sharpe ratio from adding an anomaly to the set of factors in a factor model. And the bigger the statistic is, essentially what that means is that the anomaly expands the mean variance efficient frontier spanned by the factor model by relatively more. The way we're going to compare these, because we have a lot of numbers, 120 anomalies, we just compare the distribution, the percentiles of the statistic, this percent change in square Sharpe ratio. And again, the higher distribution means worse performance by the factor model. What you see here on the left-hand side is the gross results. On the right-hand side, we have the net results. In gross terms, Famo French 5-factor model is by far the worst. And the reason for that is that a lot of these anomalies are based on momentum, the refinement of momentum. And when you don't have a momentum factor, the performance suffers significantly. The rest of the models are kind of in the middle. It's hard to tell much of a difference between them. And the Famo French 6-factor model with cash profitability tends to perform best here. Now, this is not a formal test, but you can kind of get a sense of their performance, essentially using these pictures. Another thing to note is that, very early on in the distribution, by the 15th percentile or so, the square, thank you, Irina, the square Sharpe ratio improvement becomes positive. That's not the case at all when you look at net returns, because most anomalies accounting for trading costs actually don't have significant returns. So here it's only after the 40th percentile or so that you start seeing negative returns. And what we see here after cost, the four models, Famo French, Kushu, Jiang, Perilla, Shanken, tend to cluster here. Hard to tell much of a difference. By far the best performance is by the 5 and 6 factor models with cash profitability. And again, momentum doesn't seem to add a whole lot after you account for transaction costs. We do a couple of robustness tests where we look at cost mitigation and account for trading diversification, following a paper by Victor, Roman, and co-authors. I don't have time to get into those, so let me conclude. We think that ignoring trading costs biases test of asset pricing models in important ways, in particular towards models with factors that rebalance more frequently, even though in economic terms, there's no reason that they should be very different. If you had to pick a factor, would go with a factor model, would go with the Falmouth range 5 and 6, although we try not to push it too much in this paper. But more broadly, we think our paper is a good example of why we should really care about incorporating real world concerns into finance research. Thank you.
Thank you very much, Mihail. And if you could unshare your presentation, it would be great. And now let's move to the discussion. And we are very lucky today to have Fabio Trojani from University of Geneva to discuss this paper. Fabio, you have 20 minutes.
Thank you very much, Irina. Thank you also for inviting me to discuss this paper. I think it's an amazing paper, clearly written, sharp to the point, with very clear, formal results, which are really covering a very important topic. So the fact that transaction costs matter a lot in terms of selecting asset pricing models. Now in the discussion, we're going to at first a short summary and some background ideas about the various selection procedures, and then I'm going to try to start on more general thoughts about how can we think about selecting asset pricing factors in present transaction costs. In a nutshell, it's a very careful analysis of the impact of transaction cost on the selection of tradable asset pricing factors. It is to a good extent based on this model selection criteria in Barilla-Shanken and additional regression measuring the extension of the frontier, the measured cost by this effective spread in Housebrook. Basically, the intuition is very clear, right? So factors which imply a lot of turnover, they're going to have a net returns which are going to be very different. Therefore, even though it's granted they may be near efficient, they can be exposed very inefficient. And systematically applying these ideas of correcting for transaction costs to the various selection procedures, the main conclusion is that common French factors, in particular using cash profitability, they do perform at least not worse or even clearly better than many other of the candidate factors. What is important, I think, is also the fact that the authors, they do really a good exercise in terms of cross-validating results. We know that if we work with Sharpe ratios, well, in sample it's very easy to fit a Sharpe ratio, but it's very highly not robust measure. So cross-validating across possible out-of-sample possible scenarios generated by Bootstrap, that's something which is, I think, is very important. It's very carefully done in the paper and gives a very clear additional indication of the probability by which you may select a factor against another in presence of transaction cost. And additionally, they have a couple of, I think, important exercises where they show that even though you try to mitigate cost in the trading of factors, this doesn't really change the results. And similarly, also, if you try to incorporate the fact that with transaction costs, when you start combining factors, you can diversify cost across assets, this also, again, doesn't really change the results. Now, in terms of background, I think, there's a nice intuition in the Barilla-Shanken paper, which I think is general in the sense that, well, what we want to do basically is to find a portfolio on the frontier, right? Because we find a portfolio return on the frontier, we can basically explain complete expected returns. Now, which is a good candidate? Well, we know Romanson Richard is basically the projection of a stochastic factor on the frontier itself. And that's basically what is called the minimum variance stochastic factor. Now, this guy is represented by portfolio, which we know is computed by maximizing Sharpe ratios. So it's basically the right benchmark with respect to which you can try to compute factor models to approximate, let's say, the best possible asset pricing models you could compute, either, right? So in that sense, measuring difference between a model and the best targets, let's say the maximal Sharpe ratio of the minimum variance SDF, is nothing else than comparing maximal Sharpe ratios of combining factors on one side and the Hansen-Richard minimum variance SDF on the other side. Now, if it's about comparing two different factor models, well, what I can try to do basically is to try to pick the model with the highest maximal Sharpe ratio, simply because ideally it should be nearer to the minimum variance SDF, which is the one with the highest sharp ratio. Now, the important thing in all this discussion is that all this sequence of arguments depends basically on the low one price, right? So the SDF idea, let's say even in Chamberlain and others, is based on the low one price. The fact you can do a projection on the frontier, it's also based on projections which work with no transaction cost. So all this kind of intuition is really very strongly relying on the idea that you don't have any form of transaction cost in the first place. All right. In terms of results, I think that was super well explained. This was the main picture in the beginning. You just compute the maximal sharp ratios across models before and after cost. And what you see is that even though some models, they look fantastic before cost, they look, let's say, deprecable after cost, so to speak. Right? And then the rest of the paper is more about confirming these kind of results along various dimensions, cross-validating by the fact that these sharp ratios here are full sample sharp ratios. They can be strongly overfitted, so it makes sense to cross-validate using, for example, bootstrap procedures, or accounting for the fact that you may reduce the cost in trading some of these high cost factors by various cost mitigation procedures, or the fact that when pooling factors together, you can diversify transaction costs across stocks. But in the end, all the main messages, they remain essential, right? So if, for example, if you bootstrap with cross-validation of various scenarios in which on some sample you can put the factor and you validate the factor model on another sample, you can compute how often basically one factor model is preferred to the other based on a sharp ratio comparison. And you see that basically, the 5 reference models with these values, with this cache operability proxy, they are strongly selected, not just point-wise in the sample, but very often in a booster simulation, which I think is a very important exercise, precisely because sharp ratios are so sensitive to in-sample results that we cannot really fully trust them. Also, across anomalies, I think it's a nice exercise. It's a bit descriptive, but I think it's pretty effective. So what you can do basically is to take all these anomaly portfolios, adding them to a factor model and try to check how often you tend to incorporate that anomaly to improve the factor model. And what you have left is the percentile distribution basically of sharp ratio improvement for every model. That's before cost and that's after cost. And you see that, for example, there are some rankings here which are really very much in. For example, the green line, which is basically this post-Zhengyang model, while here is somehow near to being similarly well to the best models, here is completely away. And that's basically the pendant to the exercise with the maximum sharp ratio, right? And then the additional robustness exercise, there was about cost mitigation. That was mentioned essentially trying to, yes, reconstruct the factor, but with less degree of rebalancing by making the threshold for moving across characteristics in a factor less tight. So you can construct factors which are still reproducing very well or recently the factor structure you want to have, but which require less rebalancing. While what you get is that essentially these red lines you get now after cost, they are a bit better than before, so to speak, but still you see that the Farman French models here with the operativity cache proxy, they're still doing the better job. And finally, there's also a useful exercise, which is in terms of cost diversification. Again, the idea is that if you start pooling factors, what matters for the cost is not so much the long short position with each factor portfolio, but it's the overall long short position. Some positions are going to be offsetted. And therefore, you might have overall costs which are lower to really replicate the full portfolio. Well, also here you see that with this nice bootstrap exercise, you basically maintain the same results. So the Farman French 5 and 6 factors, they are preferred to all the other factor models with very high likelihoods, even in a booster simulation. Okay? And I think this is basically the main message of the paper. And I think it's a very clear question and very topical question. Clear, simple ways to address this and verify such that basically not only you get a point estimate for comparison between models, you get also some ideas about probabilities of selecting a model against the other if you would generate alternative scenarios. Okay, so up to this point, I think it's a super clear and super important result. Now, my comments are going. I mean, the paper is really so well written that it's difficult, I think, to propose to change something. I would just submit it as it is, very simply. So what I'm going to do in my comments is more to think about general thoughts on, how can we think about selecting asset pricing models with transaction cost and also factors with transaction cost. And the idea is basically the point of going back to what you've said in the beginning, right? So basically this Sharpe ratio comparison, this is like, well, I start from Marx and Jiang and SDF, either I would like to replicate it. This means try to hire the Sharpe ratio until where I can, and that's it. So how does all this sequence of arguments change if the low one price doesn't change? So in other words, if there are generic forms of transaction cost, that's basically my motivation for doing this discussion. Right? All right, so general thoughts. Well, if you have transaction costs, you don't have this standard general result of simple spanning of the frontier. However, what I'm going to show you is that what you can do is you can construct some corresponding transaction cost SDF. You can then prune part of the expected return, which you can call them pricing errors. And then after pruning, basically, there will be a remaining part of the frontier, which is spent by two portfolios, as usual. Okay? And one of these portfolios is going just to be a particular stochastic factor, which appears after transaction cost correction. So essentially, this means that in this setting with transaction costs, you can still think about the fact, first, that the stochastic factor exists. So there is an arbitrage free market with transaction cost, and the stochastic factor exists. And then second, you can try to think about how you can better approximate any of those stochastic factors which can exist with transaction cost. Well, you can do it similarly, but with an extension to what you do in the Hansen-Jagannath minimum variance framework, by computing basically stochastic factor projections, which minimize variance, while incorporating transaction costs, or on the other side, pricing errors. That's intuition. Okay? So once you do that, and once you have this benchmark, SDF with transaction costs, you can even think about trying to, basically mimic this SDF with transaction costs using factors or assets subject to transaction costs. This would be the idea. Now, the point here, which I think is important to keep in mind, is that when the classical setting, this construction depends on the test assets. So I think, at least one should have inside all the test assets, which are constituting the factor building procedures you're testing. That's one thing. But in general, it will also be endogenous to the forms of cost and assuming. So it means the frontier you're going to benchmark, your models, your factor models, they have to be compatible with the idea of cost you want to incorporate. It was a bit the discussion in the beginning, right? You can have a proportional cost, you can have price impact like quadratic cost and so on. So you could think about undervalued subsumption from the cost to make such a construction and then try to reproduce with factors this kind of stochastic factor. That's it. Okay. So let me try to give you just a short foundation on that. So first, you can think about a market with transaction cost as something relatively simple. Okay. So you have a vector of excess returns here. You build up portfolios. When you build up portfolios, there will be a transaction cost to be paid. And the market you consider is a set of all portfolio payoffs you can trade at finite cost. Okay, that's something relatively general. For example, if you have transaction cost, you can have a specific function sigma. If you have price impact cost, you can have a quadratic function sigma, and so on and so forth. So what is then the natural, let's say, payoff space you're going to work with, which extends naturally what you do, for example, in the Hansen-Sharpe framework? Well, it will be a set of payoffs in which you have finite transaction costs. And what is going to be the price of them is going to be basically the minimum replication cost out of all payoffs which can replicate a given answer. Okay? So you can very well define a price function here. So now what is going to be tricky is that compared to the classical setting where the pricing function is linear, that's basically one price, this guy is not going to be linear anymore. It's going to be sublinear. So which means that if you try to construct a stochastic factor to approximate this pricing function, by construction, you will have some pricing errors, some alphas. And the alphas will be directly tightened to the form of the cost. Now you can exactly characterize this. So we have this in a recent paper with Sofonia Scorsai and Alberto Quaini. You can actually develop a fundamental theorem of asset pricing, which tells you if you have a given cost structure assumption here, then you can represent this pricing system in an arbitrage free market using a stochastic factor. So basically computing expectation M times R to reproduce phi. However, you cannot reproduce phi without errors. There will be errors. And what is the cool thing? The cool thing is that given the cost you specify, you can uniquely determine the form of pricing errors. That's the thing. So in other words, if I start saying like, I want to build up factors, assuming like short selling constraints, for example, then I know already what is the type of benchmark SDF I have to work with. If we want, for example, which is going to have prices biased in one direction. Okay. Now the point I want to make here is that there is a starting point as a benchmark to price assets with transaction cost. Now, like what you've done before, I can try from this benchmark to take a projection of this benchmark on some efficient frontier with transaction cost. This is going to be my target pricing canon. And then the factor building procedure can try basically to approximate this guy by comparing sharp ratios of factors after cost with sharp ratios of this guy, if I can try. So that's feasible. So basically, in the same paper, what we show is that you can now start and compute, for example, SDF, which minimize, for example, a notion of variance, like minimum variance SDF, the projection frontier, while incorporating exactly the pricing errors, which are uniquely defined by your cost structure. And how you do it? It's very simple. You basically compute the maximum sharp ratio portfolio with a transaction cost penalty, exactly transaction cost penalty you have assumed. And then the stochastic factor solving this problem is just a simple transformation of the optimal portfolio. That's it. So in this market, then the natural thing to do in order to price assets is basically to reproduce this theoretical pricing relation. And how you can try to do it by trying to use factors to replicate this minimum variance SDF, which has been constructed in presence of cost. That's the idea. Okay. So this means in particular that when you go to asset returns, there will be the composition where not all the expected return is explained by covariance with the SDF. So there will be a part which is covariant, let's call it risk premium. There will be a part aware which is pricing error, mechanically, by the structure of the cost. Now, however, once you've computed this guy, you know the form of pricing errors. So you can basically prune this part and get to a setting where the residual expected return is completely explained by covariance with that TTF. So in that setting, basically then, if you want to approach and approximate this guy with factors, you know what to do. You do the standard approach, however, with this STF kind of representation after pruning for the pricing error. So you can try to compute mimicking portfolios which maximize the Sharpe ratio after pruning your pricing errors with the same idea as in Vanilla Shanken paper, by trying to get a maximum Sharpe ratio which will be represented by this. That's the same idea, but incorporating transaction costs. So now let me just show you empirically. So we have another paper with Gábor and where we don't really work about testing models with transaction costs, but the idea more is there to construct factors for asset pricing, which incorporates transaction cost, and then using replication portfolios with transaction cost to try to get the representation of these factors and so on. Okay, that's exactly the idea. So you see, for example, here that these are factors extracted on very large international asset markets, including stock, bonds, and short-term bonds. You see the kind of STFs appearing if you don't allow for transaction cost. That's basically a standard minimum variance anti-diagonal setting, or if you start allowing for different forms of cost. Well, of course, with cost, the STF you're using is going to be less volatile. That's very natural. It's going to be more natural to replicate with transaction cost portfolios and so on. Okay. So in terms of pricing, that's what happens, for example, out of sample here. These are on this axis, these are betas with respect to these expected factors, these are the expected returns. This is what happens if you work with the factor constructed with no transaction cost. That's what happens with the factor with transaction cost. What is interesting here, you see what happens here. The betas to the transaction cost factors are relatively concentrated. The betas to the transaction cost factors, factor model, they are instead relatively spread away. Why this? Simply because STF with transaction costs are less volatile by construction, and therefore you have a cleaner description of the beta. So this is the structure of those STFs. It goes a bit like in this portfolio rebalancing story. So every STF is constructed in terms of a transformation of an optimal portfolio. That's here. Okay, but the interesting thing is that if you incorporate the construction transaction cost, you see the portfolio are less, much more shrunk towards zero and much more, let's say, sparse. So naturally, they will imply less rebalancing cost in general. That's the first thing. So replicating this guy usually will ask you basically to pay less cost. And then finally about replicating these STF projections because we want to construct factors. So what we do here basically we use just the original assets we build up replicating portfolios while paying transaction cost to the value factor. Okay, and you see basically what happens here. So basically, you have in black, this is the SDF constructed with transaction cost, in view that the replicating portfolio constructed while incorporating ex-ante transaction cost in the performance. So you can replicate this guy pretty well. And in the end, if you compute then the Sharpe ratios, let's say out of sample of this mimicking portfolio with transaction cost, they're typically systematically larger than those of mimicking portfolios with no cost. So what is the main message here? The main message here, I can start defining a pricing benchmark with cost. I can project on the frontier with cost, and I can try to replicate those guys using either original assets or portfolios of factors which in their construction incorporate the cost. And that's also, I think, a natural way to think about how to construct asset pricing models. So basically, instead of going factor by factor and making the combinations, you can go the other way around. You can build up first this SDF projection and try to approximate either with original assets or with various packages of factors. But yeah, these are just general thoughts. I think it's a very, very nice paper on a topical issue. And to me, it's given you a lot of interesting things to think about, in particular about the relation between pricing assets in presence of transaction cost. How can I approximate those pricing structures with asset portfolios or transformation of them? And how can I reduce those representations in terms of just a few factors? That's it. Thank you very much.
All right, thank you very much, Fabio, for a very thoughtful discussion. So maybe now, Mihail, you could respond to Fabio, but just take a couple of minutes so that we have time for the questions. And please, the audience, get ready to ask your interesting questions, and then you can signal that you have a question using reactions, raise hand, and I will call on you.
Thank you, Fabio. Extremely thoughtful discussion. Really, thank you for the kind words. I'm not as well familiar with the papers you referenced, but we'll definitely take a really close look at them. We really appreciate the time you put into it.
Okay, so I guess we can move to the questions. So please, who would like to be the first one?
So I have a question actually on my own paper here.
Okay, sure.
Wait, so Fabio, I'm sorry, I haven't seen the Smart SDS paper in detail yet, but trying to understand one of the applications. So can you actually use that SDF to price pre-cost factors, or do you have to use the Smart SDF to price after cost factors?
We've done both. We've done both.
Yeah, no. So that's potentially an enormous benefit for application in the sense that people want it, like it lower, like if we had we could make one of these smart SDFs that basically we could share with others, it would lower the cost of correcting for costs, for other people to correct for costs without having to necessarily learn, the entire transaction cost machinery, if I understand correctly.
I mean, one of the challenges is when you really have a rich dynamics in the cost, right? The rebalancing and so on. This becomes a bit more of a challenge. But in principle,
Sure.
You have a good proxy for the cost of time t and how they evolve. That's something you can do in the beginning. So you can basically simplify the SDF structure to start with. Then already that if you search for factors to approximate it, well, you're going to already to be directed in a direction which is not bringing you to crazy long short positions or something like that.
Excellent. Oh, thank you.
Okay, so we have 4 questions already. So Abraham, maybe you could start.
Yes, one quick question, please. Just about the time variation in alpha, because even if you don't believe in the Ponty for zoo in existing anomalies, still we do see a pervasive time variation. How do you account for it in your tests? Thank you.
The short answer is we don't, and I also have a paper on post-publication decay at transaction cost. So I do believe in that story. And again, the short answer is we don't. We have a whole lot more to say about that.
Okay, maybe Raman can be the next one.
Okay, thank you. So Mihail, normally when we have transaction costs, if we overestimate them, it's a conservative assumption, then it doesn't affect results. But in your model, actually, it's very important not to overestimate the transaction costs. So can you tell us how you guard against that?
Yes, absolutely. I think that's important. I mean, we are, you know, if you consider kind of a liquidity demander, I think we're very conservative because we don't account for price impact or shorting costs. There is a bit of a concern with the Hasbro effective spread in the very recent data. In another paper, kind of we look at that with relative to tax spread, but over the full sample, we think Hasbro and Hayden in his paper does a pretty good job of showing that his measure is very highly correlated with the actual effective spread from tax.
Actually, I would like just very quickly add, because I had the related comment. There is a very recent paper by Björn Hagströmer from Stockholm Business School who shows that effective spread is a biased measure of trading cost, and it's overestimating trading costs. So I don't want to take more time. I can give you the reference later on, I'll write. And let me give an opportunity to Svetlana to ask her question.
Thank you. So the question I had was the following. If we are living in a world with transaction costs, shouldn't a better approach would be to consider how to create a factor when trading in individual securities is related to, you know, various transaction costs, instead of let's take the factor as given and think about whether it's cheap or more expensive to actually implement it. So wouldn't it be potentially be better to sort of start from first principles and kind of go from there?
Yes, unfortunately, I didn't have time to get into some of the robustness stuff we did, but cost mitigation is what we refer to it. Was basically what you're suggesting, I believe. We essentially constructed the factors in a way that requires a lot less turnover, but preserves kind of their exposure. And that, you know, narrowed the difference in differences, essentially pre and post cost. But kind of our takeaway was similar, even when we construct the factors explicitly accounting or having trading costs in mind.
Okay, great. Let's move to Claudia.
Hi, so thank you, Irina. So I have a follow-up question on what Raman and Irina pointed out about the transaction cost. So look, first of all, it's very interesting to account for transaction costs when looking at asset pricing models. So understand that you're using the Gibbs sampler. Now, the Gibbs sampler on Joel's side uses very diffuse priors. And basically, there is a problem when you try to use this sampler at higher frequency because you have smaller samples. So what happens, the posterior is gonna resample the prior is biased. So my question is, do you impose any structure on the prior distributions when estimating your transaction costs? That's my question. And second, I have a suggestion. You may want to look at a database that SEC has created. This is a market information data analytics system database. You can use, for instance, DORA effective spread. So they have daily measures. They go back to I think early 90s, and these are data that are sourced from the consolidated data feeds disseminated by the CEPS and by the exchanges. So that would be a good source for more precise transaction cost estimates. Thank you.
Yes, thank you. That's a great suggestion, and I've actually done a similar thing in a different paper where we were looking at the post-publication decay that came across earlier, because in the recent sample, the effective spread estimates, both Hasbro and there are several follow-up papers that propose, like Abdi and Ronaldo and a couple others that propose alternative effective bid-ask spread estimates. And they suffer a bit. They are upward biased in the very recent sample. Again, in our context, we go back to the 70s, so it doesn't make a whole lot of a difference. In that paper, we actually compare kind of Hasbro, the other effective spread estimates with the actual realized effective spread from TAC and ISSM going back to 83. And they're very highly correlated. Again, we don't expect that this would make a huge difference, but we can certainly apply a more kind of robust effective spread estimator in our test.
I guess I'd also like to say that this is a first attempt and it's not perfect, but you know, not having exactly the right cost measures does not invalidate the basic critique that ignoring costs is itself a big problem. So I agree that we can potentially think about refinements that would make it, even more correct in the real world. But that's not our big issue.
Thank you very much. And the last question, please don't go ahead. We have like really 1 minute for the question.
For sure, I'll be super quick. Well, I thought it was a really cool paper. Just one quick question. So now you compute the trading cost of turnover strategy by strategy. Because all those anomalies are correlated, right? Momentum, beta, negative correlated. So when you combine them, I mean, that's going to automatically lower the turnover, right? Because momentum stocks are going to be, in opposite direction in the value portfolio. And I think the tough part is when you combine, it depends how much you can lower the turnover really depends on how you form the optimal portfolio, right? And how you form the optimal portfolio also depends on the turnover, the trading cost. So I just wonder how you're gonna, is there a way to solve that issue rather than computing the trading cost of turnover one by one, but we want to compute the turnover at the optimal portfolio level. I just wonder how you can do this. I mean, that would be a really cool thing if you can do it.
Real quick, I'm just going to try to respond. I know we're past 9 o'clock, but Victor and Roman have a cool paper in the RFS recently that does something along these lines. We have a section on trading cost diversification that was motivated essentially by their paper, although we do try to preserve the gross weight because we are focused on the factors. So once you go to optimally combining factors, then you probably want to include more anomalies, and becomes a very different question, we think, and that's kind of what Victor and Roman's paper is about. I would point you to that paper for a response to that. Thank you for the question, though, and thanks everyone for the question and the feedback. We really appreciate it.
All right, thank you very much.
Thank you, everyone.
And let's move to the second paper, and all the remaining questions could be discussed in the breakout room at 6 p.m. So the next paper is Informed Trading and the Dynamics of Client-Dealer Connections in Corporate Bond Markets, and it's going to be presented by Gábor Pintér. Please, Gábor, you have 25 minutes.
Thank you very much, Irina, and thank you very much for the organizers for inviting us to present this paper. Before I start, the usual disclaimer has to be said. Both of us work at the Bank of England, Rob and I, and this is our views and not those of the banks. So in this paper, we are asking the question as to how to measure the role of private information, and more importantly, how to compare it across different markets. So this question has been asked many times before, but this question is very difficult to answer because neither private information nor the identities of the informed traders are observable. So we basically trying to tackle this challenge, and we build on some recent literature on the order splitting literature, and we use clients connection as a proxy for informed trading activity. And what we mean by connection, the definition is basically the number of dealers with which a given client trades in a time period. So say a hedge fund, let's call it 3 sigma, deals with one dealer in a given day, let's say HSBC. The next day it would trade with 2 dealers, HSBC and Goldman Sachs. So we're going to be using and exploiting this variation in connections of the clients vis-a-vis the dealers in order to proxy for the informativeness of the client's trades. Let me just give you the main findings on this slide. So we find that clients indeed systematically perform better when they trade with more dealers, and this effect is particularly stronger for informationally sensitive clients such as hedge funds, informationally sensitive assets such as high yield bonds, and during informationally intensive days such as macroeconomic announcements, bond specific rating announcements, as well as during the COVID-19 crisis last year. And perhaps more importantly, we are finding that the role of connection seems to be more important in corporate bond markets compared to government bond markets. So the reason we can make this statement and we can undertake this analysis because our data is non-anonymous. So we are, unlike say the TRACE database in the US, we are observing the identities of counterparties in the UK corporate bond market. And more importantly, we can simultaneously observe a given client trading both in the corporate bond and government bond markets. And then we try to sort of understand that difference. So as a sort of first step into that direction, we writing down a Kyle type of information-based model to try to explain the strength or the differential strength of this performance connection relationship across the two bond markets. So one natural explanation would be that corporate bonds include more information asymmetry than government bonds, but also an alternative explanation could pertain to the structure of the interdealer markets, because in corporate bonds, typically a given bond is intermediated by 2-3 dealers. So there is much more strategic behavior in corporate bond markets, whereas in government bonds, typically all dealers trading all government bonds at a given point of time. So perhaps a second information-based explanation could be that lower interdealer competition could, to some extent, explain this differential strength of the performance connection relationship in the two markets. And then we basically finding that the data supports the first mechanism, whereas the second mechanism seems to be rejected by the data. So that's sort of the summary of what we find. In terms of the literature, we are related to basically 3 literatures. The first one is the vast number of papers on informed trading, especially in corporate bond markets. There's been lots of recent studies. The second set of papers is about the network literature on OTC markets, which typically focuses on the cross-sectional variation of the centrality of dealers and clients. We're going to be exploiting really the time series and the within client variation in connections in our paper. And the third set of literatures is focusing on order splitting and stealth trading and venue choice. And amongst these papers, a recent paper by Peter Condor and myself is perhaps the most relevant, because in that paper, we sort of proposed this measure of connection as a measure of informed trading in government bond markets. So compared to these papers and compared to the Condor paper, the main contribution of this paper is really to explore the asset level heterogeneity in corporate bonds. And I'm going to sort of try to highlight why that is important. And really the most important contribution of this paper is due to cross-market comparison. So the fact that we're observing the identities of the clients not only allows us to exploit the client level heterogeneity, but controlling for the given client, you're really learning about how markets are different, because you're observing the same client operating in both markets. So it's really the cross-market comparison, which perhaps the main contribution of this paper. In terms of the data, we're using the so-called Zen database, which covers virtually the universe of secondary market transactions in the UK government bond and corporate bond markets. Basically all clients who are FCA regulated, so regulated by the Financial Conduct Authority in the UK, they have to report all the details of the given transaction to the FCA and then to the Bank of England. So that's why we have a very, very good coverage of the market. The data covers 2011, 2017. We have about 2.5 million trades, which are between clients and dealers, covering about 3,000 assets. For each trade, we have the standard sort of information regarding price and quantity and the timestamp, but most importantly, it's the identities of both sets of counterparties. And following this upcoming JFE paper by Dong and others, we have this kind of interesting classification, because given we observe the identities of these clients, we can classify them as so-called more sophisticated clients, such as hedge fund and asset managers. These clients are supposedly more likely to be trading on information, whereas the remaining set of clients, such as insurers, pension funds, foreign central banks, are the ones that we call less sophisticated clients. And the underlying sort of idea behind this classification is these less sophisticated clients are there for liquidity reasons, hedging purposes. They might be less likely trading on information. And then we also have data on CDS positions of the given clients, which is from the data depository data set of the bank. So let me just give you just a stylized summary of the market, because some of you might not be familiar with with the structure of government and corporate bond markets in the UK. I should mention that this is actually not dissimilar to the US market. So even most of the identities are very are in fact intermediating and acting in the US Treasury market. So basically we have about, as I said, about a couple of hundreds of these black guys, the clients who trading with what we call in the UK gilt-edged market makers. So they are the primary dealers. They are the ones who are allowed to go to the primary auctions when the debt management office issues new government bonds. So basically this paper is about the relationship between the black, so the outer layer, the black circles, and these red guys. And then intermediating among the red guys are the interdealer brokers, and the identities of the IDBs as well are observable. Now, before I give you the main empirical result and the main and summarize the empirical design, let me just mention how we measure performance of a given client. So the way we do it for each transaction, we basically calculate a percentage return of a given transaction signed by the direction of the trade. So let me just give you an example. So on a Monday, let's say a client bought the bond at £100, and then 3 days later, the prevailing market price, which is approximated by the average transaction price on that given Thursday, is £120. Then the 3-day performance on that trade is roughly 20%. So that would be sort of the performance of that trade, which is then used to compute sort of an average, either weighted or unweighted client day specific average performance measure. Now, and then you can calculate this kind of performance measure on different horizons, as I will show you in a second. And this is our baseline regression design. So on the left-hand side, you have this weighted or unweighted performance measure of client I in bond J in day T over time horizon capital T. And then on the right-hand side, the main sort of object of interest is beta coefficient, which basically tells us how much higher the given performance is when the same client trading the same bond, trading on the same day, but two different bonds. In one bond is trading with two dealers, and in the other bond, say, it would be trading with only one dealer. So in this regression design, we are including a client time fixed effect. So that's kind of if you will, an improvement. For example, my previous paper with Peter Condor, which only looked at government bonds, we were not able to explore the asset level heterogeneity in government bond markets because you're effectively trading two assets in government bonds in a close approximation. So here we're really looking at the within client comparison. So this is kind of important because lots of papers the last couple of years show that, for example, a given client could be experiencing a liquidity shock, like let's say a hedge fund or a mutual fund has to liquidate a lot of assets. That sort of liquidation pressure can clearly drive the performance of the given client, but also can endogenously move the given traders' connections. So here we're sort of controlling for that to the extent that we're including the client day fixed effects. So it's really sort of identifying the performance connection relationship within client. Now, what's the beta estimated over different horizons? So basically, we're looking at 5, 10, and 15-day horizons, and what we find, an additional dealer connection is worth about 2, 3, 3.5 basis point, depending on the horizon you look at. And in this specification, we are focusing on more sophisticated clients, such as asset managers and hedge funds. Let me just show you how this looks over a longer horizon, and let me just show you the betas across the 0 to 20-day horizon. So what you see here, there is no sign of reversal, so it's strongly suggestive of an informational story that this sort of splitting orders across dealers may indeed capture information and not simply picking up, say, the given client has to trade for liquidity purposes and trading with more dealers in order to sell or buy a large amount. Note, however, this story is already sort of taken care of to some extent because we include a trading volume as a control variable for time T, bond J, and client I in our baseline regression. And as a nice cross-check, I mentioned that our underlying assumption is that more sophisticated clients might be doing these sort of stealth trading or order splitting much more than, for example, a pension fund would be doing it. So let me just show you this classification for our empirical regressions as well. So on the left-hand side, you see the previous chart. On the right-hand side, you see the same regression, which is estimated using the sample of less sophisticated clients. And what you see here, that basically most of the effect that we find is concentrated on these more sophisticated set of traders. Now, in the paper, we have 8 additional tests that try to explore whether variation in connection indeed proxies information and not something else. I'm just going to mention them here briefly. So we show that the effect indeed concentrates in high yield bonds, which tend to be more informationally sensitive. Also, the informational story is corroborated by the fact that sophisticated clients, especially when they hold a given CDS on the issuer of the given corporate bond, has a stronger performance connection relationship. Also, we find that these effects are more pronounced in informationally sensitive days, such as days that coincide with large macro announcements, days that experience or that coincide with large price dispersion, days that coincide with bond-specific upgrades or downgrades. And perhaps the most interesting and the most topical is that these effects are really, really strong during the COVID-19 period. And given the time constraint, I'm just going to give you some detail on the COVID-19 analysis. So let me just give you sort of a recap of what happened last March. So here I'm plotting the corporate bond spreads for high yield and investment grade bonds, both from the UK and the US, just to show you that the story is roughly similar in the US than in the UK. So high yield bond spreads peaked about 1100 basis point. And then after the announcements of the Bank of England and the Fed, they started falling gradually. So you might argue that this is kind of an information intensive period. There's a lot of things were going on, providing potentially a lot of opportunities for informed traders during February and March. Now, how do we link this sort of stylized facts to our empirical design? So here, an interesting suggestive sort of fact is that we are able to compute the total number of connections in the market, given that we see all the dealer client connections. So from the micro, you can come up with sort of a market-wide measure of total connections, and you can sort of track the time series of it. But there is a lot of client dealer connections of the sophisticated clients. How is this, let's say, predicting bond spreads, for example? So what you see here is that indeed connections started, total connections in the system, so about 800 dealer client connections increased to 850, so from 700 to 850 during this period, and then they started falling before the announcements happened. So it's sort of suggestive that there is sort of a positive movement, but it seems like total connections leading the dynamics of bond spreads. In fact, in the paper, we show a systematic one-day ahead forecast that indeed changes in total system-wide connections can predict bond returns. Now, but you can still tell lots of non-informational stories that could rationalize this. So we then move back to the microeconometric results or the microeconometric research design, and we look at this period by interacting these Falato-Goldstein-Hortatsu dates by our connection measures. So they were one of the many papers who provided an anatomy of what was going on in corporate bond markets last year. And what we find is that, first of all, this is a different data set, this sample, because obviously COVID happened last year and our baseline data set finished in 2017. So there is a different data set which also has the identities of counterparties, which we processed so we can run our baseline regression over the last 3 years as well. So that's why we call it out of sample test. And indeed, we find that connection, the baseline connection effect is about 2-3 basis points in the last 3-year period as well. But more importantly, the effect is much stronger during what Goldstein calls the peak of the COVID crisis period. Now, it's kind of interesting that lots of papers emphasized that this period has been about selling pressure of asset managers, such as, for example, sophisticated clients in our data set. So there are at least 4 reasons why we believe that this result, the fact that one additional connection generates much more performance during March 14 to April 13th, which is not related to selling pressures. In the paper, we sort of discussed this in detail. For example, we already have, as I mentioned before, a client day fixed effect. So if it's an asset manager who needs connections to liquidate assets and perhaps influencing its performance, that's the linear effect is already captured by client day fixed effects. We control for a bond-specific volume as well. So selling pressure, the linear effect of volume is already picked up. But also interestingly, the selling pressure started already in February and March. So where we do not see any differential connection effect with performance. And most importantly, we argue that this connection effect is about information is because the effect increases monotonically across horizons. So if this, so as you see, 5-day horizon is 5 basis point, 15-day horizon is 15 basis point. So that monotonicity in the horizon effect is strongly suggestive that it's not merely that a given client needing more connections to liquidate assets, and more connections allows the given client to get tighter deals, tighter bid-ask spreads. The fact that these guys are actually able to better predict 15-day bond returns is suggestive that it's about information and not simply selling pressure. And then we zoom in into that period, the peak period. These are our dates, and we indeed find that most of the peak period effects are concentrated on the pre-Bank of England announcement days and the pre-Fed announcement days. So about 4 or 5 days leading up to the announcement, connection effects are incredibly strong. So one additional deal connection is indeed very indicative that those traders were trading in the right direction and made huge amounts of profits. Okay, we in the paper, given the time constraints, just flagging that in the paper we do try to rule out of alternative explanations in addition to what I mentioned so far. For example, a recent paper by Franzoni and others, they emphasize that private information could be in the possession of the dealers. So more connections almost mechanically perhaps increase the access of the given clients to that information. We try to control for dealer day fixed effect and also dealer day relationship fixed effect. So trying to sort of control for the story that they highlighting that perhaps dealers are passing on information to those clients that they have the strongest relationship with. So over and above, we find that our results are there after writing these controls. Perhaps the most important sort of result of the paper is related to this comparison between corporate and government bond markets. So comparing informed trading across markets is incredibly difficult because there's this huge selection issue. So the very composition of clients participating in one market can be endogenous to how much profitability there is in that given market. So here, that selection issue is sort of taken care of because now we're looking at those roughly 600 traders in our data set who simultaneously trade both in government bonds and corporate bonds. So basically in this variant of our baseline regression, we're comparing the performance of client I on a given day T in bond K. And K here can be the government bond or the corporate bond market. And now we had a couple of extra fixed effects here because clearly, for example, even though certain central banks are operating in corporate bond markets, but central banks tend to have a niche in trading. Foreign central banks, for example, let's say Bank of China might have a niche in trading in government bonds rather than corporate bonds. So we can add these client market sort of fixed effects, trying to control for the specialization of a given client. But anyway, the main object of interest in this regression is gamma, which would tell us the differential effect of connections depending on whether the given client is acting in corporate bonds compared to government bonds. And what we find here, I'm plotting you the gamma coefficient over a longer time horizon. So there are two takeaways from this picture. Number one is that indeed the differential effect of connections in corporate bond markets are bigger, and the second takeaway is much more persistent. So that's again suggestive that perhaps there is more private information in corporate bond markets than in government bond markets. And then in the paper, we try to sort of have a framework. How do we think about this? There are two anecdotal sort of sets of evidence. We know that corporate bonds have this additional cash flow risk, which might allow informed traders to capitalize on and make more money. But we also know that that kind of stylized effects that I mentioned, or the stylized representation of the market that I showed you at the beginning, is really true for government bonds, where really 20 dealers are intermediating all the government bonds in the UK. Whereas only on average 3.5 of those dealers are intermediating a given corporate bond. So there is much lower competition in corporate bond intermediation in the UK than in government bond intermediation. And if there is lower intermediation competition in a given bond, that there might be more strategic considerations between dealers that a given client can exploit, and perhaps more information, more connection leads to higher profitability, perhaps because client can exploit the structure of the IDB market. So these are the kind of two stories that we try to conceptualize in a Kyle type of framework. So basically, just to give you, given a time constraint, I'm just gonna highlight the setup of the model. We basically have two dealers. At each dealer, you have this informed client, plus you have uninformed clients. And then we do simple comparative static, whereby we allow the informed client to be trading only with one dealer, or the informed client is trading with two dealers. And then you have these other dealers up to 20 as it's realistic as the actual market functioning. And then, but we do not model the clientele base of those dealers. And the question is how this differential, how the expected profit of a given informed client changes when it has one dealer connection as opposed to dealer connections, depending on how many inter-dealer brokers there are in the market, or depending on how volatile the given asset fundamental is. So basically, we show that the relative profit of the informed client when it goes from one dealer connection to two connection is monotonically increasing in the number of dealers intermediating in the IDB market, but monotonically increasing in the variance of the fundamental of the asset. So the second story, as I mentioned, is about perhaps there is more private information inherent in a corporate bond than in a government bond because the added cash flow risk. And the first story is about the government bond market is such that there's much more competition amongst dealers compared to corporate bond intermediation. So we have these two predictions, and the final set of results in the paper is about trying to go back to the data and try to sort of test these predictions. So the way we do it, we basically use kind of a double sorting strategy, whereby we put all the bonds into two buckets, depending on whether it's a high yield or low yield bond. So that's sort of proxies for the underlying volatility of the bond or the fundamental. And then the second dimension of the sorting will be the number of dealers that the given bond is intermediated by. So you have those corporate bonds that are intermediated by a lot of dealers relatively, and those that are fewer dealers. So these double sorting exercise essentially give us four sort of coefficients or four dummies interacting with connections. And what we find here is that it's really about so what we find here, that the overwhelming evidence is that those bonds that feature high level of intermediation seem to suggest a high connection performance relationship. So the intermediation or the market structure explanation seems to be rejected by the data according to our result. So we try to, so in this exercise, we try to disentangle some of the sort of plausible explanations behind this cross-market effect that we find when we compare connection effects across government and corporate bond markets. And basically, yeah, that exercise sort of concludes the paper. So to summarize, we basically show that client connections, variation in client connections can be used to detect informed trading activity in corporate bond markets. These effects are particularly strong for informationally sensitive clients, assets, and during informationally intensive days. And to our knowledge, this paper is the first to try to come up with a strategy to compare informed trading and compare the role of private information, not just across clients, but controlling for the client identity across markets as well. And the theory try to sort of put some additional structure on these explanations. So I can stop here and look forward to discussion.
Thank you, Gábor. And we are very pleased to have Dong Lu from LSE to discuss this paper. Dong, you have 20 minutes.
Thank you. Let me share my screen. Okay, great. But thanks for the opportunity to discuss this really interesting paper. So well, Gábor did a very good job presenting the paper. Let me just spend a couple of minutes, 1 minute, giving a very quick summary of the paper, just to give you a slightly different perspective. So the paper examines investors, trading performance in the corporate bond market by exploiting a very unique, interesting transaction level data set in the UK. The core feature of the data set is that we can observe the counterparties in every transaction. And the main finding of the paper is that there's a very strong positive correlation between the number of dealer connections and subsequent transaction performance. So let me give you one example. So let's say Rentec Fund 101 trades both Microsoft bond and an IBM bond. It trades Microsoft bond through 2 dealers and the IBM bond through 3 dealers. Rentec's performance is going to be higher for the second transaction because it's trades with more dealers in that transaction. Now the magnitude is fairly large, especially in terms of Sharpe ratio, and I'll come back to that point later. So trading with an additional dealer increases your return by about 3 basis points in the subsequent 5 days. A long-short portfolio of corporate bonds sorted by high connection clients order flows generates about 7 bips excess return in the following week with an annual Sharpe ratio of 2.3, something I'll come back to in my discussion. Now, the paper conducts a large array of additional analyses and robustness checks. I'm not going to bore you with the details again. Let me just say that the results are robust and very interesting. Now, of course, the paper is closely related to an earlier paper by Gábor and Peter, Condor and Pintér, Jeff, 2021. So in the Condor and Pintér paper, what they show is that in the treasury market, the number of dealer connections also predict subsequent transaction performance. So what I want to do in my discussion is, rather than increasing the list of robustness checks and additional analyses, I want to help the author sort of broaden the scope of the paper. Okay, so let me start with the conceptual framework. So the basic idea of the paper is that informed investors, smart investors, tend to split their orders or split their trades and send their orders to different dealers in order to get better transactions prices. Okay, now it sounds very intuitive. Now I have 3 sort of thoughts on this. Well, number one, this is an over-the-counter market. It's an OTC market. The dealers know exactly who they're dealing with, right? And it's a repeated game. It's not a one-shot transaction, right? So if Rentec or AQR, right, keeps earning abnormal returns, through their trading, the dealer's going to know about that, right? Rentec always buys right before prices rise, and then Rentec always sells right before prices fall. The dealers are smart. They're going to realize Rentec is informed. Moreover, the dealers constantly talk to each other, right? Through pinning. They get quotes from each other. They talk to each other on a second-by-second basis to learn about the market condition. So in some sense, they can also learn about investors' order submission strategies, right? Here's what I mean. So let's say, Rentec splits its orders into, 10, 20 different pots and then send to 10, 20 different dealers. Every dealer is going to change, right? It's bid-ask quotes, and dealer A is going to talk to dealer B, going to talk to dealer C. They're going to see that as soon as one of them receives a small order from Rentec, the entire set of bid-ask quotes from all the dealers change, right? And they're going to realize, Rentec or someone like Rentec, right, is doing this order splitting. So over time, dealers will learn something. They're going to infer at least something about the order submission strategy of Rentec, of AQR. Now, I think one thing will be really interesting to understand or to know a bit more is how do dealer connection, the dealer-client connections change dynamically over time? What I mean is, perhaps what Rentec is going to do is rather than sending, 20 orders, 20 small orders to those 20 dealers every time, they're going to send orders to dealers A, B, C the first time, B, C, D the next time, C, D, E. So it's going to be, sort of a very complicated order submission strategy. And I would like to know a little bit more of, how Rentec, how the smart investors, because we have the data, right? How the smart investors actually submit their order, will actually split their orders and submit their orders to different dealers dynamically over time. And how do client-specific quotes change over time? Because this is a dealer market. Well, this is OTC market. Dealers can actually give different quotes to different clients, right? The quotes that Rentec sees could be different from the quotes that AQR sees or Aerostreet sees. So it'll be very interesting to see sort of how over time things will evolve dynamically, because dealers are very, very smart. I mean, they're very sophisticated. They're learning about investor behavior all the time, and they're talking to each other constantly. And a minor point is that it's actually not entirely obvious to me that you get better quotes by splitting your orders. Right? From my conversation with my dealer friends, what they often do is they actually encourage their clients to submit the entire order to just one dealer, because then the dealer can learn more from the order flow, right? Because the dealers, in many cases, right, the dealers would want to follow the smart investors, would want to follow the informed guys, right? They would trade actually in the same direction with the informed guys to exploit the information advantage of their clients. It's totally legal, right? They're not front running; they're just following their smart investors. Okay, it's sort of an alpha trading strategy. Now, in those cases, dealers are happy to quote a narrower spread for larger orders than for smaller orders. So my point here is that things can be really complicated in those OTC markets, and I just think given this great data set, the authors have a lot more to do or to think about for this order submission strategy. It's not just about splitting their orders, right? How they split the orders over time, how they dynamically change their strategy over time, how dealers learn about who are informed, and how those informed guys submit their orders over time. Well, the second point on this conceptual framework is more from sort of investor perspective, right? How do informed investors trade? Well, the paper focuses on the trading decision, the trading behavior in the corporate bond market. Now, remember that corporate bonds are much less liquid than CDS and stocks, right? For an informed client, for an informed investor, I would argue a first order consideration is, which asset, which security to trade. Do we trade CDS? Do we trade corporate bonds? Do we trade stocks when we have the signal? Right? Remember, CDS contracts are much more liquid compared to corporate bonds. At the same time, they're sort of a purer bet on the default risk. Right? Corporate bonds, are subject to both the default risk and interest rate risk. Stocks, again, are more liquid than corporate bonds, and they also allow for anonymous trading, so it's easier to hide yourself. Now, remember, when we talk about the smart guys, we're thinking about hedge funds and mutual funds. I mean, those guys, most of them trade across asset classes, right? You rarely see a fixed income mutual fund that really, that only trades corporate bonds. I mean, they trade everything. They trade stocks, they trade corporate bonds, they trade CDS. What I would encourage the authors to do, because they have the data, is to look for similar trading patterns across different markets, right? So when Rentec splits its orders in the corporate bond market, do we see better performance in the CDS market as well? Chances are, I mean, Rentec is going to trade a bit at least, right, in the CDS market as well, perhaps in the stock market too. And also, do we see similar return patterns in these markets? Now, the third point on sort of this conceptual framework is what determines the number of dealer connections. So there are at least two possibilities. The author's view is that those informed guys, get information, then split their trades and trade with multiple dealers, right? And then they get their private signals first, and then they increase the number of dealers. Now, an alternative view is that many dealers may experience similar inventory pressure at the same time, right? And then smart investors come in to provide liquidity to those dealers and thereby earning a liquidity premium. So here's one example. So let's say a large pension fund, right, places a large order on bond A through many dealers. Now, all of those dealers have, inventory exposures to bond A in the same direction, and they all want to offload that exposure to A. Now, those smart guys, realize this is an opportunity. They come in and provide liquidity to all the dealers, right? Essentially, what they're doing is providing liquidity. Now, both views would generate the same return pattern, right? When you trade with more dealers, you're going to have better returns going forward. But under the first view, right, the smart investors are demanding liquidity. Now, in the second view, the smart investors are actually providing liquidity. Okay, and I think that's a pretty important distinction. One thing the authors can do is to check sort of the liquidity situation around those informed trades, around those split trades, right? So under the first view, what we expect to see is the bid-ask spread should be fairly flat before those split trades, and then spikes, right? Because that's where informed trading comes in. Under the second liquidity provision view, what we should see is bid-ask spreads actually widens before the smart guys come in, right? That's when the dealers are under pressure, and then the smart guys come in, provide liquidity, then the bid-ask spread should actually narrow. All right, some comments on the empirics. So the first thing I want the authors to think more carefully about is the liquidity in the corporate bond market. So corporate bonds are notoriously illiquid, right? Now, I didn't sort of collect the data or get the data myself. I just did a quick Google search online. According to a FINRA report in 2016, right, there were 35,000 CEPRs or corporate bonds traded in 2015. The average bid-ask spread of corporate bonds in 2015 was 30 bips. So here's a figure I just copy-pasted from the FINRA report. What you see here is the x-axis is the timeline from 2002 to 2015, and the y-axis is the bid-ask spreads in basis points. Now, what you see here is that from, I think the author's sample starts in 2011. So from 2011 to 2015, the bid-ask spread fell from something like 50, 60 basis points to about 30 basis points. Now, of course, the author sample ends in 2017, and I agree. In 2016, 2017, the bid-ask spread probably went down even more, but I don't think it went down to single digits. It's probably around 20, 30 basis points. Okay. Now, the first thing I would encourage the author to do is to show lots of summary statistics of the trading in the corporate bond market, right? There's not much summary stat on the corporate bond market trading at this point. I want to see things like trading volume, the bid-ask spread, the turnover rate of these different investors, etc. So let's show us these summary stats. We know something about the U.S. corporate bond market. I think we know very little about the U.K. corporate bond markets. I think that's the first thing I would like to see. Now, the second thing the author should do, in my opinion, is to convince the reader that the returns are actually achievable. Now, don't get me wrong. I'm not saying that the author should convince us that we, as outsiders, as academics, should be able to follow hedge funds and mutual funds in earning those returns. Okay, I'm not saying that. All I'm saying is we should think in the shoes of hedge funds and mutual funds, and think about sort of how they would exploit their information advantage if they have any. Okay, so the paper focuses on daily trading and daily returns. Now, just a very minor point. What if there's no trading in a bond in a particular day? What do? How do you compute the daily return? It's not clear in the paper. Now, my main concern or my main point here is that the bid-ask spread is large, right? 30 basis points. The daily return effect or the weekly return effect is about 3 basis points, right? Now, it's very, very unlikely that the smart investors, hedge funds and mutual funds are looking for quick profits in this market. Right, we're talking about 30 bips bid-ask spread, not even price impact, right? And if you're just earning 3 bips over a week, I don't think you're looking for a quick turnaround. So my suggestion here is to look at returns over much longer horizons, right? Rather than looking at returns in the next 5 days, 10 days, and 15 days, look at returns the next 6 months and 12 months. And perhaps we'll get something, we'll get a much larger return effect. Now, if you talk to corporate bond traders, my sense is that they're not, none of them is turning over their portfolio on a weekly basis, right? Because that's suicidal. the trading cost is going to kill you. So I would really encourage the authors to extend their analysis, right, to the next 6 months, to next year, even 2 years. That's sort of the horizon that corporate bond investors corporate bond mutual funds and hedge funds are looking at. Now, a very quick comment on the Sharpe ratio. This is the main, to me, this is the main result, the most convincing result of the paper. Yeah, thanks. So what the authors did in this table is to classify all the clients into high connection clients and low connection clients. And then they sort all the corporate bonds into 10 deciles based on the trading of high connection clients and the trading of low connection clients. Okay, high connection clients in the top panel and low connection clients in the bottom panel. Okay, now you get about 7 basis points in the next 5 days, 10 basis points in the next 10 days. Now what's striking is the t-stats, right? The t-stats is about 5.6. Now remember, they have you have a sample period of 6 years. Right, so just some very simple calculation. You have a sample period of 6 years. The annualized Sharpe ratio is going to be 5.66 divided by the square root of 6. You get an annualized Sharpe ratio of 2.3. Okay, so the weekly return to this long-short portfolio is about 7 bips or 6.8 bips. You multiply that by 50 times to get the annual return. That's about 3.4% divided by 2.3, the annualized Sharpe ratio. The annual vol of this portfolio is under 2%. It's actually 1.5%. That's extremely low for corporate bonds, right? So normally, when you look at sort of long-short portfolio volatility, annual volatility in the stock market, it's on the order of 5–10%. I mean, 10%. I think it's already very low. We're looking at 1.5% annual vol for corporate bonds. I mean, that seems too low to me. Okay, maybe check the standard errors. Now, one thing, so one possibility is that the portfolio returns are actually computed from overlapping windows, right? You're looking what those portfolios are rebalanced on a daily basis, then you hold them for 5 days. This overlapping return window could be driving this very high t-stats. And also a very minor point, you need to tell us the difference between the top, if the difference between the top panel and bottom panel is statistically significant. Here's a very similar concern. So here the authors conduct a panel regression at the client day level. So again, the point estimate is fairly small. We're looking at 0.35 bips in the next week with a Sharpe ratio of 1, right? T-stat of 3 divided by square root of 6, you get 1.2, 1.3 Sharpe ratio. Now that implies again a very, very low standard error or portfolio volatility. Something to think about. Okay, some other detailed comments on the empirical analysis. This is extremely interesting to me. So many non-dealer investors also act as liquidity providers in this market. So remember what so Gábor didn't spend time on this, but the paper actually constructs 2 connection measures. One is based on connection to dealers, and the other one is based on connections to dealers plus other clients. Now, to me, I want to know more about who those clients are, right? Those non-dealer clients who also provide liquidity in this market. Are they hedge funds? Are they mutual funds? Do they also post quotes somewhere? Is there an electronic system? And also, how do other investors choose which liquidity provider to trade with? Do I trade with dealers? Do I trade with non-dealer liquidity providers? Okay, what drives my decision? I think that's a fascinating question to look at. And relatedly, who are the dealers in the CDS market? Okay, do the dealers do the dealers in the do they share the same set of dealers with the corporate bond market? If they do, can dealers learn across markets? Okay. Let me say one thing on the specification, then I'll stop. So the main specification is a 3-dimensional panel setup. There's a lot to like about this 3-dimensional panel setup. You can even control for client, date, fixed effect, right? And then you're literally comparing within a client date. For some of the transactions, you increase. You have more. Yeah, see that. Thanks. You have more client dealer connections, and for some of the transactions, you have fewer dealer connections. And how the number of dealer connections differentially affects transaction performance. And I think that's great. It's a great setup. 2 comments. Well, number one, with this 3-dimensional panel, you are overweighting clients and bonds with more transactions. right? And this can potentially overstate the effect. The point estimate from this 3-dimensional panel is 8 times the point estimate from a 2-dimensional panel, where we collapse bonds, all the transactions to the client level. That kind of tells me, you're overweighting the clients with more transactions. A minor thing, you also control for bond year fixed effects. I'm not a big fan of bond, of bond year fixed effects, and the reason is once you do that, the regression is no longer predictive, right? Because you're demeaning bond returns using the entire year of returns, right? So you're using future information to demean the current return, which is not ideal. I would just go with the portfolio approach. I think it's much easier to interpret and get the standard errors right. These are minor things, and I'll send the discussion slides to the authors later. Okay, let me conclude here. I think it's it's a very interesting paper. The empirical results are robust and interesting. I'm not going to add to the list of robustness checks. Two things. Well, number one, I think the authors could think more about sort of the conceptual framework, right? Number one, to think more about the dynamic relations between dealers and clients. Remember, this is OTC market. It's a repeated game. The dealers kind of learn a lot about their clients through those repeated transactions. Number two, how to inform dealers trade across markets, right? When you think about hedge funds and mutual funds, they don't just focus on corporate bond markets. They look at CDS, they look at stocks, they look at derivatives. How do they trade all those things? And number three, do inform investors demand or provide liquidity? Okay. And the second point I want to make is that I strongly encourage the authors to look at longer term returns, right? Given the trading cost in the bond market, I don't think those smart investors are looking for very quick turnaround and very quick profits. Okay, that's all I want to say. Thank you.
Okay, thank you very much, Dong. Very detailed and interesting discussion. So Gábor, would you like to take a couple of minutes to respond? And I would like to encourage everyone to prepare their interesting questions.
I would just like to express my gratitude to Dong. We're very grateful for the points. They're very useful, very practical. I think most of the points can be addressed reasonably straightforwardly. Yeah, so I just like to thank him. One of the main issues that we've been working on is indeed the second point he mentioned. That we're aware of that. Let's say ROCOS or AQR. These hedge funds are trading in many asset classes, not just in government bonds and corporate bonds at the same time, but they're trading on repo and futures and CDS. So in fact, this is what we've been exploring the last couple of months, because we have the data as well on futures transactions as well as repo, which is obviously, given last year's crisis, that's the center of the attention. So we actually been trying to do exactly what Dong is suggesting. Trying to merge in these other trading activities of these clients to get a fuller picture of their trading activity and trading performance. So it's work in progress. So that's probably the most difficult and time-consuming point to address. But the other ones we're gonna get to it, and that will definitely improve the quality of the draft. Thank you.
Okay, time to move to the questions. Who would like to ask a question? Okay, very good. We have Claudia. Claudia, please go ahead.
Thank you, Irina. So I have a quick comment related to the liquidity points made by Dong. So since 2014, the Volcker rule was implemented in US, and the Volcker rule applies to foreign entities that maintain a bank branch in United States. So what I think is that the Volcker affected broker dealers will try not to hold inventories. Now, so according to the Volcker rule, they cannot trade with hedge funds, and hedge funds are actually the sophisticated investors in your study. So since you have the identity of the dealers, I was wondering if you can split your analysis by Volcker affected and non-Volcker affected broker dealers.
Thank you. We can certainly do that, and that's something we have not thought about it yet. So yeah, absolutely. Thank you, Claudia.
Okay, and also during the pandemic, you may want to think about the constraints due to Basel III. I think Basel III applies in US. I'm sorry, in UK as well, right?
Yes, exactly. So that's why, with the COVID, I mean, I sort of had to rush through it, but we try to be sort of extra careful with what we saying, because a lot of the discussion is about selling pressure and the constraint on the dealers, as you said. But the most of the effect that we identifying here is really within the client. So trading the ideal scenario which we try to get to is the same client trading with the same on the same day, but two different bonds, one with dealer A and B, the other one is with dealer A only. But you're right. Yeah, it's something that we can still try to be more rigorous about controlling for dealer specific effects. Yeah.
Okay, any further questions? All right, it looks like we can stop for 5 minutes to have a coffee, and then we will start at 4 p.m. Central European time. Thank you very much, Gábor and Dong, for discussion and presentation.
Thank you.
Time to get started. So we're going to have the following paper, Bond Convenience Yields in the Eurozone Currency Union, and it's going to be presented by Zhengyang Jiang. Please go ahead, and you have 25 minutes.
Okay, thank you, Irina. Thank you, and thanks for putting our paper on the program. This is joint work with Hanno Lustig from Stanford, Stijn van Nieuwerburgh from Columbia, and Mindy Xiaolan from UT Austin. In this paper, we're going to study the bond convenience yields in the Eurozone currency union. So to start, let me show you a picture of sovereign bond yields in the Euro area for the past 20 years. In this picture, different colored lines represent the time series of bond yields issued by the governments of different Euro area countries. We can see that since perhaps the financial crisis, different countries started to have very different yields. As we can see, a big dispersion, which was particularly big during the Eurozone debt crisis, but there was also difference afterwards. If we think about this yield from the first principle, we will notice that this is an integrated financial market with a single currency. So we should expect the same risk-free rate for all these countries' investors. Then traditional wisdom says that we should regard the variations in sovereign bond yields as driven by the credit default spreads. And indeed, this has been the standard and very appealing explanation of the yield dispersions we see in the data. In this paper, we ask whether this is all there is in the data that we see. So conceptually, we can decompose a country's bond yield in the following way. Here, we use time subscript, T for each time, and I for each different country. We can first write a common risk-free rate, given that this is a currency union with integrated financial markets. This risk-free rate should apply to all the countries, which therefore do not have I superscript. Then we have default spread, which accounts for the differences in the default premium, as well as the default probability. Lastly, we may or may not have a residual term, lambda, which we interpret as convenience yield. We'll see more about it, but for now, let's regard this as the residual from this decomposition. To quantitatively assess the magnitude of each of these components, we could find a proxy for the common risk-free rate. But here we choose a different style. We actually do a difference between each country I and Germany. Because the risk-free rate is common, it should drop out in the difference. So we can express the difference between two countries' yield into the difference of the two countries' default spread minus the difference in the two countries' convenience yield. Because we can observe the yield and the default spread from the CDS data, we can plot the time series of the difference between two countries' convenience yields. These are given in the following figures. Immediately, we can see that for countries like Portugal, Spain, and Italy, the convenience yield differential with respect to Germany is pretty big, and it is particularly widened during the sovereign debt crisis. For example, if I look at Portugal, the convenience yield differential could be as large as 6% per annum. On the other hand, if we look at some other countries like Austria, Belgium, and Netherlands, which are traditionally thought of as safe or fiscally sound countries, along with Germany, we still observe significant variations in their convenience yields relative to Germany. For example, if we look at Netherlands, in the peak of the sovereign bond crisis, it also has a negative 30 basis points per annum as the convenience yield relative to Germany. So this is our empirical measurement of the bond convenience yields, which is conceptualized as a residual from this decomposition formula. So in this paper, we take this as an empirical fact and develop a theoretical framework to understand the equilibrium determination of the convenience yields. Prior literature looks at its magnitude and mostly relates its variation to microstructure drivers, such as bond liquidity, short selling frictions, and transaction costs. In this paper, we're going to take a macro perspective. In particular, we highlight the role of the intertemporal government budget condition, which puts a joint constraint on convenience yields and fiscal conditions. In a currency union, because the risk-free rate is common to all countries, then the convenience yields have to play a more active role to adjust in order to equilibrate the bond prices in response to fiscal shocks. We will lay out this theory in detail, which at the end will show that the convenience yield variations are also tied to fiscal conditions of different countries. Then empirically, we quantify that convenience yields are quantitatively important. They explain the majority of variations in sovereign bond yields. In addition, consistent with our model, fiscal conditions also explain convenience yields, thereby linking this variation in bond price residuals to macro drivers such as fiscal conditions. Lastly, even though the convenience yields are at the magnitude of several or tens of basis points, we do a simple accounting exercise and show that these convenience yields imply very large fiscal costs to peripheral countries which have negative convenience yields relative to the German bonds. And this brings additional or interesting new thoughts into the designation of the common currency area as to where the boundary should be drawn. Okay, so this is the plan of the paper. Let me start with the theoretical framework. Let's start with some very basic bond pricing formula. In the first row, we write down the Euler equation for the one period bond valuation. We use P to denote the bond price for country I with maturity K+1 at time t. If we only look at the blue parts of this formula, this is something we're very familiar with. It shows that the bond price today is the expectation of the pricing kernel times the bond price in the next period, T+1. And by having another period passed, the bond maturity also goes down from K+1 to K. For the common pricing kernel M, because we think there is a common marginal investor who buys or sells all these different Euro area countries' bonds, we think this is a single pricing kernel, and therefore we do not have a country superscript for the pricing kernel. This would then be the Euler equation for a default-free bond. Then to make things more realistic, we can introduce a default spread where chi denotes the default indicator at time T+1 for country I, and chi could be between 0 and 1 as well to indicate a partial default. If chi is 0, there's no default, and then this reduces to the case without default. What we additionally have here is an Euler equation wedge, which is interpreted as the convenience yield in this bond pricing formula. So when this wedge C is positive for a certain country, it means that the investor requires a lower compensation as a form of future return to hold this bond relative to what the Standard Euler equation would imply. The higher the Euler wedge, the lower the expected return investors have for this particular country's bond. With this valuation equation, we next introduce the one-period government budget. This budget shows that the government's budget surplus in a country should be supported by the debt. In particular, if we have a high surplus this period, it should be able to pay down the expiring debt without requiring new issuance. On the other hand, if the budget surplus is negative, in which case it becomes a deficit, then the government needs to issue additional debt to fund the current budget deficit. We can combine these two equations by plugging in the determination of bond prices, and under a transversality condition that rules out Ponzi scheme, we have the following formula for the joint determination of surplus and bond price. In particular, on the left-hand side, we have the market value of total outstanding debt in a country I. On the right-hand side, we have two terms. The first term is the present discounted value of government surplus. So we have tax minus government spending, or T minus G, which is the government surplus. And the first term is the discounted version of that for the entire future horizon. The second component on the right-hand side is the present value of a seigniorage revenue. In particular, we have the Euler equation wedge C to express how much investors are willing to give up in each period relative to the Standard Euler equation. We multiply that by the amount of outstanding debt in that period, which in a sense measures the current amount of seigniorage revenue in a particular quarter or year. And then we sum up all future seigniorage revenues weighted by the pricing kernel to derive the present value of seigniorage revenues. This is one of our central results that link debt value to both a fundamental part, which is the present value of government surplus, and a convenience yield part, which is the present value of seigniorage revenue. In particular, if we think about earlier theories, such as the fiscal theory price level, then it only equates the debt valuation to the present value of surplus. So what we have here additionally is an additional part or component, which is related to the convenience yield of government. In particular, when the government earns a high convenience yield, we can think about that as government enjoying a lower funding cost. So this funding advantage then gives rise to this notion of seigniorage revenue. Now, let me put this in the form of a proposition by converting the bond price on the left-hand side into its three determinants, as I have introduced in the intro. The bond yield can be decomposed into a common risk-free rate, a default spread, and the convenience yield. So this formula then equates the debt valuation from the financial market to something fundamental about surplus and the seigniorage revenue. I have several comments about this proposition. First, if exchange rates are flexible, in other words, if we're looking at countries not in a currency union, then we should expect the interest rate or risk-free rate to be different across countries. And in fact, this has been the key adjusting mechanism to equilibrate with government surpluses in the traditional models. However, since we are now examining a currency union, this risk-free rate should have been the same across all the countries in the union. So there cannot be additional variation across countries driven by this part when different countries have different surplus or different amount of seigniorage revenue. The second term in bond valuation is the default spread, which could adjust, and I think it should adjust when the surplus or government fiscal condition changes. However, the government default spread is disciplined by the default probability and risk premium, so it is pinned down by a specific formula, which then leaves us only the third term, which is the convenience yield. we argue that in the currency union, since the risk-free rate has to be the same for all countries, then for a given time, the convenience yield across countries could play an active role to respond to changes in different countries' surplus and senior-rate revenue. In particular, when a country has a stronger fiscal situation, the present value of surplus should go up, and this has to correspond with an appreciation of the debt in the form of an increase in the convenience yield. So this is the mechanism that brings fiscal conditions and fiscal shocks in relation to the observed convenience yields in the bond market. Alternatively, we can also think about some additional shock that makes people want to hold, say, German bond as opposed to all the other countries' bond. So this should be an increase in the senior-rate revenue of German government, which would also lead to an increase in the convenience yields. Okay, so this is really the key prediction of this model. We also have a specific example in which we have risk-neutral investors, constant risk-free rate, constant default probability, and in doing so, we actually lock down the variation in the default spread. And we have an exponential bond maturity structure to keep things tractable. In that world, we further show that a shock to government surplus in a particular time leads to a proportional increase in the convenience yield, as well as in the Euler equation wedge, which is a one-period version of the convenience yield to a government debt. So this relationship then predicts that when we have an increase in a country's fiscal condition, we should be able to observe a concurrent increase in bond convenience yield in the same country. Okay, so this is the key prediction of the model. Next, we're going to bring this model to the empirical results. We're going to show the three results that I have mentioned in the introduction. First of all, let me say something about summary statistics of this particular data set. So we have bond yields and we have the default spread from CDS data. Both the bonds and CDS are denominated in the euros, and we use the same maturity just to make sure that they are matching in all the possible ways. We compute the difference in the convenience yields between one country and Germany so that we can get rid of the common risk-free rate, which we do not observe directly, and we can express the convenience yield differential as the difference between the two countries' CDS spread minus the two countries' bond yields. In particular, I have this tilde notation to denote the difference between country I and Germany. We note that before 2007, the average convenience yield between each country and Germany is pretty small. The average is only -5 basis points. This is all in percentage terms. After 2007, these convenience yield differentials widen drastically. The average convenience yield differential is -33 basis points, which is smaller than the variation in interest rate, but now it starts to be more and more important. The first exercise we do is a variance decomposition to compare whether the bond yield variation is driven by the default premium or by the convenience yield. So we can calculate the variance of these terms. On the left-hand side, we have the variance of the bond yields over time. And on the right-hand side, we can write this down in two ways. Let me work backwards. First, we can write this down as a covariance between the bond yield and the default premium minus the covariance of bond yield and convenience yield. These results are reported in the last two columns. Conceptually, these two components should sum up to 100%. What we find is that the covariance with convenience yields explain about 98% on average before 2007 and 64% on average after 2007, which is a majority of variation in bond yields. In comparison, the component associated with default premium, or the CDS, only explains, for example, 36% after 07. So contrary to the prior belief that the bond CDS or default premium drive variation in bond yields in the Eurozone, we actually find that this convenience yield term to be capturing a much larger component. Similarly, we can also express the right-hand side as the variance of the convenience yield and the variance of the default minus their covariance. In this world, we also find that the component attributed to the convenience yield to be capturing a larger variation. Of course, in this world, we have a covariance term, which also seems to be pretty big, which signals co-movements between delta, the CDS, and lambda, the convenience yield. But just to take the conclusion, we find that the convenience yield components seem to drive the cross-country variation in bond yields in the euro area, both before and after the financial crisis. So this is related to our model prediction that when the common risk-free rate is fixed in the currency union, the convenience yield has to play an active role to adjust and satisfy the intertemporal government budget condition. Now let me turn to the second prediction, which links the convenience yield to different countries' fiscal conditions. Here, let me start with the cross-sectional results. The dependent variable is the average convenience yield of a single country across time. We regress the country-level average of convenience yield on this country's average government surplus to GDP ratio, debt to GDP ratio, and surplus cyclicality, which measures the cyclical component relative to a common factor. We find that countries with high government surplus, with low debt to GDP, and low cyclicality in surplus, all of which should suggest a safe government fiscal condition, and they are all associated with a higher convenience yield. So in the cross-section of different countries, indeed, governments with good fiscal conditions correspond to high convenience yields. Now, let's also look at the time series. So we fix a country and look at its variation across time. We regress the time series change in convenience yield of that country on that country's government surplus to GDP ratio. We find a positive coefficient, which is not absorbed when we control for the bid-ask spread, which is a measure of transaction or liquidity, or when we control for the log GDP growth. We find that when one country improves its fiscal condition by having a high surplus to GDP ratio, the convenience yield of that country also goes up. Relatedly, we also find that when the country has a high surplus, the default spread goes down. So these two components actually reinforce each other and lead to a big decline in the bond yield of that country. So by combining the cross-sectional and time series result, we always find a positive association between convenience yields and fiscal conditions. Lastly, because the convenience yields are related to the present value of future government surpluses, we can also replace the explanatory variable by the forecasts of future surplus. We take this from consensus economics and find that increase in the expectation of future surplus is also associated with a higher convenience yield, which is also consistent with our theory's prediction. So just to conclude on this second point, we find a positive association between the convenience yields and both current and expected future fiscal conditions. Here is a third and last empirical point before I conclude. This is an accounting analysis. Here we calculate the revenue loss of a country, say Italy, relative to Germany, due to the fact that Italy earns a lower convenience yield on its government bond relative to Germany. To compute the revenue loss, we do a product between the convenience yield differential between Germany and Italy times the bond duration, because the convenience yield is per annum. We have to multiply this by duration, just as what we would do to an interest rate change. And we multiply that by the issuance amount. This then measures the revenue loss of each country relative to Germany, due to the fact that it has a lower convenience yield relative to Germany. Here is our last figure. We make this plot by doing a cumulative sum across the time. We find that for countries like Spain and Italy, the revenue loss due to a lower convenience yield relative to Germany lead to about 5 to 8% of the GDP in these countries. Even for countries like Netherlands and Austria, this revenue loss is also non-negligible, around 1 to 2% of the GDP over the past 10 years. So this suggests that if we put all these countries in the same currency union, but their fiscal rules do not integrate, there will be differences in convenience yields related to their fiscal conditions, and countries with weaker fiscal conditions or weaker convenience yields will end up having a much higher costs in issuing debt to the level of several percentage points of the GDP. So I should stop here. In this paper, we develop a theoretical framework to think about convenience yields in relation to fiscal conditions in a currency union. Empirically, we find results consistent with this model's prediction. And in particular, we find convenience yields to be driving a large fiscal costs in countries with lower convenience yields. This brings new consideration on the literature on optimal currency area, as well as unconventional monetary policies such as QE or other bond purchasing programs. Thank you.
Thanks a lot, Zhengyang. And our discussant is going to be Rosen Valchev from Boston College. Rosen, please take the screen. It's yours, and you have 20 minutes, and we're looking forward to your discussion.
Thank you for inviting me to discuss this paper. It was very interesting. I think he's given me quite a lot to think about. And let me share with you some thoughts. I couldn't follow up on all my thoughts, but I'll share with you some of my thoughts. So first, this is relating to now, I'll call it bulging recent literature on convenience yields. And let me just define it just to make sure we're on the same page. This is the idea that safe bonds offer a return over and above their interest rate, okay? Or maybe falling for the default probability risk premium. You know, they typically, in many papers have documented in the past, there typically remains some extra residual, which a number of researchers has tried to rationalize through this idea that, you know, safe assets are somewhat close to money. Money is a special asset investors are willing to hold at zero return. Some of the specialness of money maybe transfers over to bonds. And we call that the convenience yield. This is this extra little wedge in the other equation that Zhengyang showed you, something that is not accounted for purely by the interest rate that the bond offers. I think this kind of idea, this you know, this additional pricing component of the bond is very exciting. I've used it in my own research. A lot of other people have used it in their research as well. It could potentially resolve a number of puzzles. What are the key challenges that I see typically in this convenience yield research agenda is that, number one, it remains a little bit of a nebulous Euler residual or yield residual. Is what exactly is it? What is it driving it? I think that's a big question. It's quite interesting to consider. And number two, relatedly, because we don't exactly know which mechanism is, you know, responsible, how do you measure it in the data? That's a related but separate concern. Now, this paper here has two key ideas. One is it offers us a physical theory of the convenience yield, which helps put some more restrictions on what the behavior of the convenience yield should be in theory, right? So it's going to tell us something about what is it that should be driving the convenience yield. And number two, it offers a novel way of empirically measuring the convenience yields, exploiting the fact that within a currency union, we can have a common risk-free rate, which really makes it, and not only that, but they're also exploiting the fact that the Eurozone also happens to have a liquid CDS market, very important. But taking both of these two things into account, it's a very neat way of computing the convenience yield then as a differential from one country within the Eurozone to another country also within the Eurozone. Okay, so I said two ideas. Let me show you simplified versions of both. at least simplified in my head. So I always get confused with the maturity of bonds and don't like summations, so I try to remove them as much as possible. So let me imagine the government issues a Conzo bond. Okay, so this thing never comes due. I make my life easier and assume the coupon is 1. It has some price PT, but you know it can default. And imagine that upon default, the government just is immediately allowed access back into the credit markets and initiates another, another cohort of these Conzo bonds. Okay, so what's the pricing equation? I mean, it's something that Zhengyang already showed you. Essentially the Euler equation tells me that the value of this bond today must be the risk neutral expectation of the default probability and what I'm expected to receive tomorrow in terms of financial returns, which is coupon of 1 and also this future price PT plus 1. But then in addition to that, there's something more. There's this term CT here, which is log, so we write it as exponent of CT. So the other equation is not only the discounted expected future financial return on the bond, but it's also something else, which we call the convenience yield. Okay. Having defined this idea of the CT wedge in the typical Euler equation, I'm also going to define the prices of 2 other hypothetical consoles. One, which I'm going to call the very standard bond with no default risk and no convenience yield. I'm going to call that price P star. Another price P tilde is going to be on a bond that can default, but it has no convenience yield. Okay, so if I use these 2 hypothetical bond prices, I can rewrite the Euler equation that I started with at the very top. Just adding and subtracting the P star and the P tilde terms, and we can get the observation that the price of the bond that actually is traded in the markets. I'm assuming that P star and P tilde assets just don't exist. So the price that actually is traded in the markets, this PT, could be expressed as a deviation from this ideal no default, no convenience yield bond P star, right? So it's going to be P star plus 2 deviations. 1 deviation is essentially a compensation for default risk, and another deviation is essentially the value of the convenience yield of an asset that has the same default profile, but doesn't have this extra liquidity or convenience value. Now, I can also iterate on this Euler equation, take logs and minuses. Basically, what you're going to get is that the value of this bond today, and I've kind of expressed it in terms of a yield here, negative log 1 over P. The yield here could be viewed as a term that comes from this pure risk-free rate, let me call it RT, so no default, no risk, the default component delta T, and then the convenience component lambda T. Know that these are all sums. These are going to be cumulative expectations also, future interest rates, future defaults, future convenience yield terms CT, because it's a long-lived asset. Okay, and this is also something that's going to show up in the empirical analysis Zhengyang does, because they use 5-year bonds, so it's not infinite sums, it's up to 5 years ahead in the horizon, but these are cumulative sums. Okay, so this is the pricing of the bond. The government budget constraint looks the following. S denotes the surplus. So this is the fiscal surplus of government taxes minus spending. So what does the government do? I can issue a new amount of these consoles, QT. So time T, this is going to be the remaining outstanding amount of bonds I have. QT minus 1 is how many of these bonds I came into the period with. So QT minus 1, that's just the additional issuance of debt. When the treasury goes and issues another 100 billion par values, this is QT minus 1. Now the treasury doesn't necessarily get 100 billion, even though it wishes 100 billion par value, because there's a price PT, right? So this is going to be the money that you get, and all of this needs to make the budget constraint hold, meaning that I need to be able to pay the debts I came into the period with. Okay, so I can continue forward being solvent. So you iterate on this budget constraint, and you get the so-called intertemporal government budget constraint, and you can rearrange it in a way that says, well, the market value of the debt that you come into the period with, and not only that, this is really the market value of the liabilities you come into the period with. So that's both the market value of the kind of the principal I have to return, but also the coupons I have to pay this particular period. So the market value of your fiscal liabilities must equal the expected present discounted value of budget surpluses, and also this additional convenience yield seniorage. There's some convenience yield seniorage that sneaks into this equation, because essentially the government is allowed to issue these, as long as C is positive, the government is allowed to issue these bonds at a premium, at a lower interest rate than otherwise. Now, if I recall also that the market price of this instrument is going to be a combination of interest rate terms, default terms, and convenience yields, I can essentially say that, okay, let me take the right-hand side of this government budget constraint as a given, and imagine a shock to either the budget surplus or maybe the future convenience, whatever, but something on the right-hand side changes. Then in order for the government to remain solvent, the price must also change, right? The markets must immediately reprice the debt because they know that in the future, for example, the government has less fiscal resources. So the markets are immediately going to reprice this debt and make budget hold. Okay, so how am I going to reprice the debt? Well, it could be through a higher interest rate, it could be through a higher default rate, or it could be through a lower convenience yield. And this last part, the lower convenience yield, is what Zhengyang would like to take to the data and finds a lot of interesting results about. Okay. So the second idea though is I need to measure these lambdas. Okay, and that's, I was telling you that this is a complicated thing to do. Here the insight is that within the Eurozone we have two benefits. Number one, I've got a number of different sovereigns that have the exact same currency. So they're when you're pricing them, if the markets are at least somewhat integrated, you'd imagine that there is a common risk-free rate. I think that's a totally reasonable assumption, right? So when I'm thinking about this idealized no default, no convenience yield euro bond, the French investor must agree on the pricing of such an idealized asset with the German investor. That's what the assumption is saying here. Okay, so then there's going to be this common risk-free component RT. Now, in addition to that, there's the default premium, but the Eurozone is nice in the sense that all the sovereigns have fairly liquid CDS markets. So we can measure these default components, default premium delta IT here. And the remainder is going to be the convenience yield. That's how we're going to measure the convenience yield. So first, we're going to cancel out this common component of R by looking at, let's say, I should have reversed this equation probably. I'm going to look at the difference in the yields between Germany and another country, let's say France. This differential between Germany and France cancels out the R, the common risk-free rate. And then on top of that, I'm going to minus the CDS differential between Germany and some other country like France, which is going to cancel out the delta I term. And I'm only left with lambda I minus lambda D. Okay, D being Germany. So I'm only left with this convenience differential. I think it's a very clever approach. It gets around a lot of empirical issues we typically have. Just to give you a sense, if you're not familiar with this literature, what kind of hoops people have. One of the seminal papers, I think arguably is just much. I was just saying that this what they have here is a very clever approach. It gets around a lot of tricky issues that the literature has. And I was going to mention this paper. They look at credit spreads too, but for the US, I don't have this other sovereign that I can look at. But let me just go forward. And I just tell you that the results they actually get are quite interesting. These are the convenience yields. So Zhengyang already showed you that the estimates they get. And what you see here is that there's a lot of variation, even for countries which we might think as safe or equivalent to Germany, like Austria, Netherlands, there's a lot of variation. And obviously Spain and Italy, they have big deviations too. So what this graph is telling you is that the convenience or liquidity value of the Spain, of Spanish bonds is much lower than German bonds, okay? And it's also volatile. Another interesting result that they find is this cross-sectional correlation with fiscal conditions. You can look at the average surplus, average debt, surplus cyclicality, but the point is that governments that seem to be in weaker fiscal positions also have convenience yields that are lower than Germany. Okay, so what are my comments? I think it's a great paper, but I wanted to get some more sense, some more tangible sense on what are these convenience yields. I think the fiscal theory is a nice additional restriction on convenience yields, but it's not really a theory of it because you still have this wedge in the oil equation that's unexplained. So the theory of the convenience yield really is must tell me why are investors happy with this valuation of the bond. The fiscal theory equation just tells me that otherwise government budgets are going to be non-solvent, but I still need to know why are people valuing a safe asset more than another safe asset. So to give you
a parallel with the fiscal theory of the price level. There, the fiscal theory of the price level is really only operational when the central bank allows inflation to vary, right? You need to have this extra flexibility. But here we do still have this Euler equation, which puts strong restrictions on the C. So really, they work together. I still need to know what's happening with the C in the Euler equation. Okay, I think the estimates of lambda are very interesting. They're suggesting me a demand-driven convenience yield. I'll get to that. And I have a couple of further policy analysis ideas. So fleshing out the convenience yields. And all I have here to say really is that I don't want another model. I just wanted some story so that the reader can relate to what is the C, and also maybe some data that speaks to the fact that the lambda that you guys identify is indeed tangibly related to something that we would think of as a liquidity value. Because at the end of the day, the lambda is still, you know, a residual. Some people might question what exactly is it. Well, I found it very interesting. I found your results both in the time series and the cross section remarkably similar, or not similar, but remarkably correlated with some experience in the euro repo markets that I kind of recently saw on this paper by Schaffner and now Detzel from the BIS, both cross-section and time series variation. They're basically looking at kind of like effective spread in the repo markets, the realized volatility of the repo market, scarcity premium. What they're after basically is to say, look, in the Eurozone, these repo markets essentially allow you to obtain liquidity, you know, in exchange for government debt as collateral. But there's even though all these government debts are denominated in euros and the loan is in euros, whether I show up with a German bond, with a French bond, or an Italian bond, actually carries a different haircut and different spreads and so forth. But intuitively, just think of it carries a different haircut. Okay, so one micro foundation for the C term is that having a safe asset allows me to relax some budget constraints somewhere, because if I happen to need money, imagine there's idiosyncratic shocks to kind of money needs or something, or wealth, and I happen to need money in a particular state of the world, if I have the safe asset, I can show up in the repo market and obtain the liquidity very quick, right? So maybe that's how, maybe through relaxing this Lagrange multiplier on a potentially occasionally binding budget constraint, that's where the convenience yield comes from. And there are big differences in whether I have a German bond or a French bond or Italian bond, even though they're all European sovereigns, okay? There are big differences, time series, cross-sectional, they're big difference in the realized volatility. And the differences are not only in the second moment, the differences are also in the first moments, meaning that the rate at which I can borrow with German bonds is significantly lower than the rate at which I can borrow with Italian bonds. I mean, that's a clear benefit of having one safe asset over another. That has nothing to do with the interest rate that I'm going to get paid anyways by the government and that sovereign bond. Okay, so I think there's a lot of interesting data there on repo markets that tracks closely with your estimates. This SRT paper is cool because they show that all this dispersion doesn't drive any arbitraging kind of activity. They even have the positions of traders, and they say, well, no one seems to be taking active positions to close these gaps. So all these guys agree on the gaps, right? So that kind of sounds like something that is in the Euler equation. They agree that, you know what, the German bond is just more valuable than the French bond. Okay. Then the convenience yields that we get in these lambda hats, I wonder if they're driven themselves by the default risk, right? So when you think about convenience yield stories in the literature more generally, I can think of supply stories and demand stories. The supply story is that, you know, I have this asset, and the supply is big of the asset, and the more supply of the asset I have, the less scarce it is, so the less valuable it is. But there's another demand story, and Arvind has worked on some of them, is that when an asset is effectively safer than another asset, so think about here, these are all sovereigns within the euro, but the CDS spreads are different. You know, it does kind of look at the German asset is safer than the French asset and safer than the Spanish asset, and so on. Well, maybe if it's safer, it actually makes it more useful as a collateral somewhere, and then there's going to be just more demand for this kind of collateral, which is going to increase that C term, that convenience yield term. Right, so, but these are two different stories. One story is that the Spanish government just issues a whole bunch of these bonds, and the investors don't know what to do with them. They're not scarce anymore, so their value is low. Another story is that the Spanish government is very risky. No one wants to use their bonds as a collateral. That's why their convenience yield value is low. Okay, so let me take a little bit of a look at the data. I constructed a partial reconstruction of Zhengyang's data set, but I'm also too lazy. I only have two variables. I only did the convenience yield and then the CDS differentials within the Eurozone. And I think I don't even have that at the lens. But anyways, the point is that this convenience yield that we estimate, which is essentially this residual between yields and CDS differentials, is still related to the mean difference in CDS. So whatever I back out as a convenience yield, it still tells me that the countries with high risk neutral default probability like Portugal have a very low convenience yield. And it's not just some outlier thing over here happening. It's really continuously adjusting. 1 minute, great. Continuously adjusting Germany, then France, Austria, and so on and so forth. Now, remember also one last thought I'll give you, that is there was this, I told you the convenience yields that we compute these lambdas, they're really cumulative because they're 5-year assets. So when you iterate on the thing and kind of look at the pricing equation, it's going to tell you that whatever lambda I estimate is going to be the expected future convenience yields. Okay, that's what we want to get. But there's also this covariance term. This is the covariance with the risk neutral default probability in the future. Because essentially when I buy a long-term asset, what I'm buying is a promise of convenience yield today, but also one tomorrow. But how much do I value this one tomorrow is going to depend on the probability I still have that bond, it hasn't defaulted on me. And also is going to depend on how much do I value that state of the world tomorrow. So there's this covariance thing. And there's some evidence that maybe the volatility of the CDS is also related to the estimate of this convenience yield that the paper backs out. So the country with more, so these are countries with more volatile CDS, right? So nothing to do with their average value. This has been canceled out. But countries with the more volatile CDS also have lower convenience yields. So that kind of talks to me about this covariance term being higher. I think I only had 1 minute, so let me just conclude. The couple more policy ideas, they're not so interesting, but they're just different ways of presenting the same results. I think it's a very cool paper. I think its fiscal theory provides a novel restriction on convenience yields. I wouldn't quite call it a mechanism, but it's definitely a restriction and a very interesting null hypothesis. And I think the cross-sectional identification within the Eurozone is very clever. Good way to back out convenience yields. Thank you.
Thank you very much, Rosen. And now let's give an opportunity to Zhengyang to respond. Please take a couple of minutes, and then we will move to the questions from the audience. And please get ready with your questions and use a raise hand feature so that I can call on you.
Okay, thank you. Thank you, Rosen. This is wonderful. So I'll be very quick. 2 things. First, there is still a sense that we are still in search for the fundamental driver or cause of the convenience yields, which could be conceptualized as an additional set of restrictions we need to pin down this bigger equilibrium. I fully agree that this is something we're still in search for as a literature as a whole. And your point about this repo market origin is also very interesting. I have read that paper by Ronaldo and co-authors, and thanks for this reference. We'll think about how this could bring into our framework, at least empirically. The other point, convenience yields are also correlated with the CDS in a cross-section and perhaps in the time series as well. So this is a very interesting hypothesis. And this should point us to first check this empirical correlation in our data set more extensively. And I also agree that there might be an angle to put this in a theory way, in a better way, and to say that convenience yields are also driven by safety, which will also manifest itself in the CDS premium. So thanks for all these great suggestions. All these are well taken.
To move to the questions. So Fabrice, please go ahead.
Oh, thanks, Irina. I guess I have 2 comments. One is I think the authors should relate this paper to this literature on bond negative basis. I mean, there's several papers that look at, U.S. corporate bonds versus U.S. corporate credit default swaps, which, I mean, in some sense, what Zhengyang is doing is just measuring the negative basis of a variety of sovereign government bonds in Europe. So I think that's one comment. And then the second is, I guess, again, always the same concern around liquidity of euro-denominated credit default swap contracts and sovereigns. I mean, back in the days where I was in credit markets, most of the liquidity was in US dollar-denominated contracts. And things may have changed, but we wouldn't be in a situation where we're drawing like big conclusions based on 3 guys in a garage trading these contracts. And then more importantly, these contracts have a cheapest to deliver option that, may have an impact on, the author's analysis. So I think it would be important when they think about default risk and as, measured with CDS spreads, to think a bit harder about maybe the cheapest to deliver option.
Should I answer one by one or get all the questions?
Yes, please answer one by one.
Okay, thanks, Fabrice. The point on corporate basis is very interesting. We're aware of the literature and we're going to do more about that. You raised a very interesting point about the, let's say, the microstructure issues of CDS, including liquidity, cheapest to deliver, and all these intricacies resolving the court default process in the context of sovereign default. So this is something we're still trying to push harder and to get better sense of the noise or the issues we're dealing with. One thing we have been doing is, first, we have recognized that the USD denominated CDS is more liquid. For the euro denominated ones, we have been reporting two sets of results, one using everything we have, and second, we use a 5-year CDS in euros, which arguably has the highest liquidity in this market. So we've been checking our results in both sets for now, and they both support our results. But this is a very serious issue, and we're trying to take it to have a better sense of the noise we're dealing with. Thank you.
Okay, let's move to the next question from Abraham.
Thank you very much, Irina. A quick question, please. So you approach the convenience yield as an alpha right now, but when you look at the data you showed us, we have seen a lot of variation after 2008 and before. So if I think of the convenience yield as a preference shock, it will be in the SDF. So why did you choose to look at it only as an alpha rather than also as a beta and therefore as a price factor in the SDF? Thank you.
So let me make sure I understand your question, Abraham. So you are saying that I am looking at convenience yield as a deviation from the Euler equation, which is why you are calling this alpha, or as the alternative is to look at this as a risk premium. Is that your question?
Yeah, the way you look at it is as an alpha, but it could also be that it is a price factor in the SDF.
Oh, okay. So yeah, that's a very good point, and we need to be very clear on this. So here's our take on whole literature of convenience yield as well as this particular data set. If we regard this as a convenience yield, then the Euler equation would hold. The risk premium or beta just manifests itself as a particular term in the pricing kernel, but the pricing kernel with the Euler equation will still hold. This doesn't seem to be the case both in our setting as well as this broader literature on convenience yield, which finds that this is really a deviation from law of one price. So that's what we motivates this as alpha, not a beta. Of course, they could be correlated, which means convenience yield is correlated with price risk factors, but there's still a very important distinction between the two.
Okay, so Raman, would you like to add on this question?
Yeah, my question is similar to Abraham's, like basically fiscal policy is country specific, and you assume that the convenience yield is also country specific. Yet you keep assuming that the SDF is common across countries. So I find the two things contradictory.
Okay, very good point. So this framework, I would argue, would fail if different countries have different currencies and therefore different investors have different SDF. The only way we make this comparison between German bonds and say Italian bonds under this framework is to assume that there is a single investor, a marginal investor who buys and sells both bonds, and this investor has one currency denomination, which is a euro. So this is our starting point and why we assume there being a single SDF to price the cross-section of different countries in the Eurozone. And this is how we can assume that there's only one common risk-free rate, which will drop out after taking the difference between Italy and Germany. So this is exactly related to the discussant point on how we can measure this only in the context of euro area, whereas if we do this in a different country, then this would fail.
Like, I'll just follow up short by saying the expected return on the SDF could be the same across countries, but the SDFs could still have different volatilities.
So I'll say, so this would be a concern if the different SDFs in Italy versus Germany have different implications for risk-free rate, because then we're unable to distinguish variations in cross-country risk-free rate versus variations in convenience yield. So I'll say for now, this has been our assumption, given that these markets have been sufficiently integrated. But if the world is indeed as you described, then we will have a confounding factor, which is exactly the difference in the different SDFs. However, we don't think that's likely the case given how integrated these Eurozone markets are and the fact that these bonds are denominated in the same currency.
Okay, and the last question is from Pierre. Pierre, please go ahead.
Hi, yeah, thanks for, I thought, very nice and clear presentation. I was wondering about your interpretation of those fiscal costs that you present at the end, where you sort of say, you know, people that pay, you know, I guess peripheral countries have this large fiscal cost, and how we should think about unions, right? I mean, I was thinking about how you think about that, given that obviously those countries, if they left the union, you might expect that, you know, they would also pay much higher yields. They would have to have, you know, a different risk-free rate, and obviously there's also all these fiscal transfers for being part of the union. So I was wondering how you think about those estimates of costs.
Okay, great. That's a great question. And I have to say, in the last slide, I mentioned the implication for currency union, but this is really some future work. We're only putting together an estimate of how big this cost is by comparing the convenience yield of, say, Italian bond against Germany. Now, to think about how big this cost is in relation to the other alternatives, I think what we should be keeping in mind is two different alternatives. One is one Eurozone country leaving the union and having its own currency, which is exactly what you just described. And the second is the possibility that all the Eurozone countries integrate both monetarily and fiscally, and therefore have the same bond or similar bond with the same convenience yield. So if we compare the current situation with what you described, I think it's unclear which one is beneficial to the peripheral countries, given that if a country takes a different currency denomination, the risk premium in that currency could have gone up by quite a lot. Whereas if we compare the current situation with the fiscal union, then the story is opposite. In that case, we could expect that different countries all have higher convenience yields due to their joint bonds being safer. So this is still just some first numbers to think about, but I think comparing against these two benchmarks will be very interesting for the next steps to think about policy implications.
Okay, so thank you very much, everyone. Fabrice, did you want to add anything? Or it's an old...
No.
Okay,
it was an old hand raise. Sorry about that.
Okay, no problem. So now we are going to be moved to the joint room for the joint asset pricing and corporate finance session, and we should be there in a couple of minutes.